and everything should be perfect. I want to get started soon. Hey guys, so do you see Wolf in Spaces, or is it just me who can't see him? Because he's DMing me and saying that he joined, but for some reason I can't see him to make him a speaker. Do you guys see him?
I don't
No.
see him, Max.
Yeah.
I don't see him either.
Interesting. Well, he will be in the middle of our speaker, so he has approximately probably 40-50 minutes to figure that out. So I have 3-4 speakers right now, so we can go ahead and get it started. It's 2 o'clock. We have for some reason it's not showing me how many people joined so far, but based on scrolling I can see that we have quite a few people here. So we're gonna go ahead and get started. For my speakers, thank you so much for joining today for Chapter 2 of Financial Fitness event. I'm really excited for everyone taking the time on this Sunday afternoon. It's been quite a success so far. This is our third event when it comes to financial fitness. Couple months ago, we started with the prologue when we had like approximately 15 amazing speakers covering different industries. And now we just go chapter by chapter covering, doing a deep dive on a particular industry. So today we will be covering fintech and digital payments, which is I'm very excited about. And I think Mark should be able to introduce our the first speaker.
Sure. Yeah. Thanks, Max. Appreciate it. Thanks, everybody, for coming again. I think we've got some great speakers today. I did want to mention, Max, we're still going to keep it till like last time, right? 10 minutes ahead, just to double check. Is that correct?
Yes, that's correct.
Okay. So I think we're going to do 10 minutes a speaker. I think our first speaker, if I'm not mistaken, is Matt Cochran. And I think everybody knows him pretty well now with Seven Investing. So if you're ready, go ahead.
Yeah, thanks a lot, Mark, and thanks a lot, Max, for having me. For those who don't know me, I'm Matthew Cochran. I'm a lead advisor with Seven Investing. I was fortunate enough to get involved with Seven Investing when it was founded last March by our founder, Simon Erickson. And the way it's just set up is that investors aren't hopefully, getting those clickbaity articles or clickbaiting marketing feeds a lot, or articles that are just designed for SEO algorithms to pick up, but like just real deeper dives and consistent updates on our monthly recommendations. In other words, we really try hard for the focus to be on the quality of work and not quantity. Every month I make a recommendation, and these are always for long-term holdings and never for quick trades. And there, of course, recommendations are sometimes repeated, but and we also podcast, live stream, and weigh in on some market news throughout the month. So just for fintech, it's a very large space. It's short for financial technology. So let's just start there. It's the act of using technology to better accomplish traditional financial tasks, usually by making them cheaper, safer, and more convenient. But like when you think back, I mean, like the ATM machine would be an example of like early fintech. So I mean, there's just lots of ways you can interpret fintech. The credit card, when that first came out in the 50s, that was an example of fintech. But I think if you start at like But I think if you start at like, how does technology making financial services cheaper, you can like easily see where the industry is going today. So like, finance is more affordable than ever before. I mean, we have $0 commissions. If your parents or grandparents invested, no, like in lots of 100, like you'd have to buy 100 shares of a stock at a time, and the commissions would be outrageous. Like they could be over $100 at a time. And now we have these amazing products like low priced index funds, $0 commissions where we can trade in and out of stocks all the time, um, whether that's for better or for worse. And so it's just finance is just more affordable than ever before. Uh, finance is more convenient than ever before. I mean, look at Rocket Mortgage. Like, what a great example. And I'm not saying it's a good investment, but like you can do everything from a from an app now for your to set up your mortgage. Whereas when you just think of all the paperwork and how tedious of a process this is, you can just see like how fintech can make uh, uh, a lot of financial services more convenient than ever before, and it's safer. In the old days, you'd have to carry around cash if you wanted to buy something, and if somebody stole that cash from you, you weren't getting it back unless you caught that person with the cash still on them. And nowadays, of course, you have credit cards and you have chips with EMVs or cards with EMV chips on them. Like when those chips were introduced, counterfeit credit card fraud went down 76% within a couple of years. Credit cards usually have a $500 liability by law. So if somebody if I steal someone's credit card and run up charges all around town for thousands of dollars, at most that person's only liable for $500. And almost all credit card companies just waive that $500 liability fee. So finance is safer than ever before. And so what I want to do is just real quick with the rest of my time is just look at the entire consumer financial industry from a big picture perspective. We remember like big banks, they're the legacy companies in this space, right? And I'm not sure how they will fare as investments, but I actually think big banks will essentially be fine. I believe they can do more than survive in today's digital world. They have the resources, especially in the cases of JP Morgan Chase and Bank of America, where they can release like great apps where consumers can do a lot of great things. I think they have robust digital offerings, and I think those kinds of banks will be fine. In his recent annual letter to shareholders, JP Morgan Chase CEO Jamie Dimon shared a lot of things, but like there's two comments in particular I'd like to focus on. He said one of the things he said was that the regulatory landscape gives an unfair advantage to fintech over big banks. We don't have to go through all of them, but the list is pretty quite substantive. Banks have higher capital requirements and much more extensive liquidity requirements than fintech companies, which basically means they can't lend out all of the deposits they take in. Deposits at banks must be FDIC insured. Jamie Dimon shared that this cost JP Morgan $12 billion over the last 10 years. So there are just a lot of heavy regulations around how banks can use their customers' data, and they're under a lot of know your customer and anti-money laundering requirements. So they're commonly like if you see the KYC or AML like requirements or regulations, those are what those mean. And it just means they're very limited in how they can use their customers' data. Like over time, I would expect like these regulations to even out and for fintech companies to come under more regulation. It's just something to watch for and be aware of. But Jamie Dimon also said in his letter, like fintech is here to stay and banks are going to have to invest heavily in tech. Here's just a quick quote I'm going to take from his letter. He says, importantly, big tech, and he specifically lists Amazon, Apple, Facebook, Google, and Walmart is here too. Their strengths are extraordinary with the ubiquitous platforms and endless data. At a minimum, they will all embed payment systems within their ecosystems and create a marketplace of bank products and services. But all that being said, like all the advantages that fintech companies currently have over banks and like all the tech players coming in, I don't think it's time to count big banks out yet, especially again, JP Morgan and Bank of America. JP Morgan invested about $5 billion in technology last year, and that's going to increase to $6 to $7 billion this year. They have 41 million active mobile users, and those mobile users can do a lot on their mobile app. JP Morgan's built data centers around the world, basically creating their own private cloud, which is going to make their bank a lot more efficient. And just a recent quote from one of his, a short quote, but just a recent quote from one of his conference calls. He says, you have a tremendous amount of AI being used in asset and wealth management, in trading, and commercial banking prospecting, and it's literally the tip of the iceberg. Whatever we say today, 10 years from now, it will probably be 50 times more than we're doing today. And I would spend anything to get it done faster. Bank of America, the other big bank I mentioned, they have 31 million mobile active users. They have 17.2 million Erica users, and that's its virtual financial personal assistant, which is pretty capable. That was up 67% year over year in 2020. Digital channels now make up 45% of Bank of America's total sales. That's up from 32% in 2019. Zelle volume, which they participate in, grew 80% year over year in 2020. So you can just see, like, I just think these two big banks, they're not going to go quietly into the night. And sometimes about fintech, we get all caught up in the future and the disruptors coming. And I just wanted to mention, like, I don't think, especially these two big banks, I don't think you should count them out. I also think small community banks can also survive. Funny enough, like my parents retired to a very rural South Carolina community several years ago. And that town, it had one bank. It was a one branch bank. And I think a bank like that, serving a community like that, can also survive. Because if you have a banking need in that community, that's the only place to go. And I think a lot of times also we forget, like when we get caught up in all the technological capabilities, at the end of the day, anyone handling your money, what they're really selling is trust, right? Because if you don't have trust, it doesn't matter what technological capabilities you have, you're not going to get that. And these small banks, they still have the trust of their communities, I think. The legacy banks that are in trouble, I think, are the regional banks. Those are like the banks that are large, like in certain regions, but they're not as big as like JP Morgan Chases or the Bank of America. And they're a lot bigger than those small community banks where they don't have that, but they might have lost a personal touch with their community over the years. I think these banks aren't going to keep up with the agile and innovative tech companies like PayPal or Square. And look, so as far as where I'm coming though, I mean, I've talked a lot about banks, but PayPal and Square are my two largest holdings. And I believe like PayPal and Square are going to continue to take market share. And that's where I think we're seeing so much consolidation. Like in 2019, BB&T merged with SunTrust to form Truist. That created the sixth largest U.S. commercial bank at the time. Last year, PNC bought BBVA branches in North America for $11.6 billion. And that created the fifth largest bank in the U.S. And don't be surprised if you're going to continue to see consolidation. This M&A activity, it'll help banks with branch efficiency, and it also gives them more firepower to compete with the digital offerings that companies like PayPal and Square are going to continue to roll out to the market. If you just think real quickly about Square's Cash App's evolution, I think it's easy to see where they want to go. In 2013, Cash App started pretty much just as a peer-to-peer payments platform. It was useful for sending money to friends and family, and that was pretty much it. And then in 2015, users could then use Cash App balances to pay for Square sellers' merchandise and services. And from there, it continued to roll out new features every year, growing its user base as it went. So along the way, it introduces debit cards and reward programs and the buying and selling of Bitcoin and commission-free stock trading and direct deposits. Last year, it purchased Credit Karma's do-it-yourself free tax service. And I think where it's going, soon it's just going to be this all-in-one personal finance app where users can spend, invest, and save through the app. And I think you see a remarkably similar evolution with PayPal and Venmo. The future of the financial industry is probably an app. It's not those pretty glass buildings downtown. But there's plenty of space for more than one winner. But I think many banks are going to be playing catch up and have a hard time doing so. But like of the large banks, I think Chase and Bank of America are probably best positioned. So I want to keep to my 10-minute time limit and not bore everyone. So I think unless there's any questions, I think I'm done.
Yeah, that was pretty good. I really appreciate it. Thank you, Matthew. I 100% agree with you that Square and PayPal has the bright future when it comes to fintech industry, but at the same time, you don't want to count out the large bank players. So thanks for your talk. Thank you so much for taking the time. I really appreciate it.
Thanks for having me.
Yeah, absolutely. And I think Mark stepped away for 1 second, so I'm going to go ahead and introduce our next speaker. Perfect segue from this talk. We're talking about Square and PayPal. The next is Tim. He will talk Square. Tim, the floor is yours.
Awesome. Thanks, Max and Mark, for having me on today. I just want to thank the audience and for joining. And this is just a great event that you guys are putting on, so thank you. So my name's Tim Soida, and today I'll be discussing Square. Before I get into this, I just want to disclose that Square is my number 2 holding, and what I present today should not be taken as investment advice. To lay the foundation, I would like to start by outlining a very simplistic way to view Square. Square provides simple tools to enable businesses to make a sale and for consumers to transact with each other and grow their business by combining software, hardware, and financial services. Some product offerings consist of point of sale, developer platform APIs, hardware, online commerce, payroll, managed payments, customer relationship management, business banking, and team management software. In the fourth quarter of 2020, the seller ecosystem generated gross profit of $427 million, up 13% year over year, which was a slight miss caused by the pandemic. For the Cash App ecosystem, it provides financial products and services to help individuals manage their money. Cash App is Square's growth engine and represents over 60% of Square's total revenue today. Its goal is to redefine the world's relationship with money by making it more relatable, instantly available, and universally accessible. While it started back in 2014 as strictly a P2P app, they have since stacked other product offerings to provide users with banking services such as direct deposit, debit cards, ATM access, equity, and Bitcoin investing, a rewards program called Boost, free transfers from the US to the UK, and integration with Square sellers mentioned previously. Cash App is now looking to offer a range of services comparable to that of traditional banks, including personal loans, credit cards, mortgages, and insurance. Cash App delivered strong growth in Q4, with gross profit up 162% year over year to $377 million. Cash App continued to drive strong acquisition of new customers and retained its existing base. In December, Cash App had more than 36 million monthly transacting active customers, up 50% year over year. The goal for Square is to mesh seller and Cash App and create the world's largest closed-loop payment ecosystem, cutting out intermediaries. This will provide Square with a larger share of the economics and the ability to cross-sell services between among consumers and merchants without the friction of traditional payment systems. Now let's get to the point. Why do I think Square is differentiating themselves, and why do I think they have a leg up on competition moving forward? I think it starts with innovation and product development. This has and will lead to new organic user growth, acceleration in market share, better omnichannel to onboard more services per customer, and will increase engagement and increase monetizable active users and average revenue per user. Over the last couple of years, Square has outperformed PayPal, in my opinion, on the innovation front. It was the first to put Bitcoin on their balance sheet and the first to allow Cash App users to buy and sell Bitcoin. Square was also the first to get approval to become an industrial bank, which enables them to provide lending to customers, both sellers and consumers, which I believe will be huge for them in the long run. PayPal has yet to get approval on this. With greater product adoption of things like Bitcoin and Cash Card, Square has seen increased engagement and monetization. Gross profit per monthly transacting active customer reached $41 in the fourth quarter, up 70% year over year. Secondly, Square has the lowest customer acquisition cost, and I'll refer to this as CAC moving forward. So for anybody that doesn't know what a customer acquisition cost is, it is the amount of money a company spends in marketing and sales to acquire one customer in the same period. A primary driver of allowed them to onboard millions of new users organically, using their network effects to lower the customer research. PayPal and Square has amassed 60 million active users organically in the first 7 to 10 years of existence. Something that took JP Morgan more than 30 years and 5 acquisitions to reach. Square's CAC in 2020 was $5. PayPal is currently around $20, and a traditional bank is up to $1,500 to onboard a customer with a checking account. This is more than 70 times that of Venmo and 300 times that of Cash App. Thirdly, it looks like leading indicators are suggesting that Cash App will outperform over its peers. On the digital search front, using Google search trends, Cash App interest has surpassed that of Venmo since December of 2019. With much of that could be attributed to the growing network effect, unique marketing campaigns in collaboration with influencers and social media, and with popular podcasts such as Artificial Intelligence and the Joe Rogan Experience. They also have very successful marketing campaigns on Twitter and Instagram, such as Cash App Fridays, where those that use their cash tag have a chance to win money from Square. Some of these weekly campaigns have generated over 1 million comments on Twitter and Instagram combined. On the app download front, the downloads are very impressive. Cash App is the #1 finance app in both the iOS App Store and the Google Play, and was #9 and #5 app in the iOS App Store and Google Play overall, based on downloads in the United States. Square will become an advertising and CRM powerhouse as they reach maturity, in my opinion. By removing third-party merchants and collecting offline, online, and consumer spending patterns, there is no one better suited than Square from a data collection perspective. I expect them to better monetize brand and direct response advertising to further boost, no pun intended, its business as it matures to create new revenue streams. Square has the potential to undercut competition with Boost. Boost has been a very powerful tool to drive Cash Card adoption and increase customer engagement. In the fourth quarter, new Cash Card customers adopted Boost at a higher rate, and Boost actives spent approximately 2x more than Cash Card customers. Boost allows Squares to personalize rewards for customers in real time while providing broader utility for Cash Card. They have recently expanded Boost, enabling unique rewards that drive engagement with other products in their ecosystem. In the fourth quarter, Square launched Boost to earn Bitcoin instantly on Cash Card purchases, and a special Boost, which customers can unlock after receiving their first. Square is and will use its seller base as an acquisition channel for new Cash App users by offering its loyalty via Cash App. This will enable sellers to use Boost as an advertising platform or facilitating closed-loop transactions between Cash App users and Square sellers at a lower cost for sellers than standard credit card processing fees. Of recent, they've made improvement on the M&A front with recent smart acquisitions that offer very unique value. They've made smart acquisitions such as Credit Karma's tax platform for $50 million and the majority stake in Tidal for $297 million. On Tidal, they consist of 3 million subscribers and 60 million songs. Tidal has been trying to use its star power, such as Jay-Z and Beyonce, to create unique experiences to broaden their offerings beyond music streaming. I'm expecting Square to plug in payment processing immediately and offer lending services for new artists, and eventually develop a creator shop reminiscent to Square sellers so they can build out their brand and better monetize their talents. One key thing that I don't believe is really being mentioned is that Tidal subscribers are strongly concentrated in meccas of the US, with concentration in New York and California. This might be a strategic way in other higher income demographic areas. On the international expansion front, I believe that will be key to sustain hyper growth in both Cash App and their seller business. Over the next few years, I hope to see acceleration in existing international markets such as Canada, Japan, UK, and Australia. Square recently did a Twitter space talking about some emerging market opportunities and what the cash dependency is in certain markets. They had an interesting statistic in Japan where roughly 80% of current transactions are in cash. It just goes to show the market potential in Japan if they're able to get even a small fraction of that. In Australia, many large banks have left rural areas, which may lend Square the opportunity to kind of fill the gap there. On the emerging market front, I believe Jack Dorsey's outreach in Africa will eventually bear fruits in terms of economic expansion and digital payments, but I believe this is likely years away. On the Twitter, I believe Twitter and Bitcoin are going to be the Trojan horses for Square's international expansion. I did a thread on Twitter a few months back on this. With Twitter, I expect in the coming months, we will see tipping and super follows enabled in the public domain. Paywalls to build out their offerings by using super follows. Down the line, Twitter will enable e-commerce, which is where I believe they will create a competitive advantage of offering Boost discounts to consumers who use Cash App to transact with Square sellers, undercutting the competition. For Bitcoin and crypto, I believe Bitcoin will be the key for international expansion as it provides real-time settlements and no currency conversions, removing outside intermediaries from the process of cross-border transactions. If you think of utilizing Twitter and incorporating Bitcoin into the social element, I believe this will be a great way for them to expand their international offerings and be able to utilize third-party platforms and payment systems to be able to increase adoption on their platforms. So what am I looking for going forward? So Square's earnings are upcoming this Thursday after hours. I want to see better performance on the seller side with small and medium-sized businesses reopening from the pandemic. I also anticipate good growth on Cash App and monetizable active users, but I would not be surprised to see slight deceleration in user growth quarter over quarter. I'm hoping that the monetizable active users will increase as well as the ARPU. While today was intended to give you more of a qualitative overview of Square and where they'll differentiate from competition, I will be doing my first review article on Square, outlining what I discussed today, but also incorporating my view on its current valuation and where I think the price is headed in the future. So if you're interested in this, please give me a follow at TP Soida, and I really appreciate everybody's time, and back to you, Max.
Yeah, that was great, Tim. Thank you so much. Square is one of my largest holdings as well. Not the largest, like Mate just said, but I'm really excited to watch this company grow in the future. Earnings next week definitely will be interesting. I will be paying close attention. Probably will tune in to listen to the CEO's earnings call. I'm really excited about their international growth. I agree with you. It's one of the areas that definitely we need to look, and something that will probably differentiate them from the rest of the competition. So thank you so much, Tim, for your talk. Super excited about this. And the next person is Jay, who will cover Square's probably main competitor, which is PayPal. So Jay,
Hey
floor
guys,
is yours.
can you hear me okay?
Yes, I can hear you.
All right, great. Thank you. So first of all, thank you to Max and Mark for inviting me to this great lineup of FinTwit legends. I'm nowhere close to this lineup. I'm pretty humbled to be again part of this great group of people to just speak to you guys about PayPal. PayPal is my top 10 holdings. I purchased PayPal purchased in 2018 after basically observing it for since 17 or 16 or 17 since the IPO'd in 2015. And it's one of my longest holdings alongside with Square. I actually purchased Square and PayPal both during the same week, matter of fact. So yeah, I'm pretty bullish obviously on this fintech world, and where PayPal and Square both are going. So my topic is obviously the PayPal. So PayPal, brief history. They actually originally IPO'd in 2002, and then was acquired at 1.5 billion valuation by eBay, and then spun off in 2015, happened at around 50 billion valuation, and the current valuation of PayPal is 300 plus billion. So not too bad. Last 20 years for PayPal, from 1.5 billion to current valuation over 300 billion. So yes, it's a mega large giant fintech company, and so it's not going to be your typical 5x stock in like next year or 2 years or things like that, but I do see them growing slowly and steadily, and capturing more and more market share, like Matt initially mentioned. So just some brief numbers of over last 5 years. So when they IPO'd in 2015, the revenue was 9 billion. The current valuation, or 2020 revenue, is 20 billion, and where they are going is their medium term estimate in 2025 is 50 billion. So again, the growth is not slowing. I'll take that 20% growth annualized compound over next 5 years any day. So it's great. Their active users in 2015 was 180 million. Current users approximately 400 million, and they are estimating in 2025 the active accounts or active users should be around 750 million. Matter of fact, most of the growth of PayPal is outside the US. So more than 50% of revenue is generated outside the US. So yeah, in terms of the core business of PayPal, it started mainly as the payment transaction, mainly integrated with eBay. It was 40+% of eBay's revenue by 2012. So the cashless transaction at most of the US merchants, actually, matter of fact, more than 80% of US merchants offer PayPal at the checkout. Obviously, that's an online transaction. Recently, they have introduced the QR code for more physical in retail stores, and it actually accelerated over the last couple of quarters, or last year, I would say, based on this whole COVID touchless transaction, if you will. In addition, they offered the financial services to the consumer base. So latest addition is obviously the crypto trading. Crypto trading actually allows them to have more user engagement, very low churn. Matter of fact, the CEO's comment on the last conference call was that the people who actually trade crypto via PayPal have more than 50% of the users who trade crypto on PayPal actually check the app daily. So more user engagement, lower churn. They are offering credit cards and debit cards through their PayPal app as well as Venmo app. And I'm sure then the next few discussion there will be more detailed discussion about Venmo as well. They recently launched buy now, pay later services on their app. The great thing about PayPal is their optionality in the business. By offering buy now, pay later, it's actually much easier for merchants to just integrate that service as no additional cost. It's the same take rate for PayPal. But they launched this service in October 2020, and they already, in the US and the UK markets, they already have more than 3 million active accounts actually using this service, and they're planning to ramp this up in other markets as well, other merchants in the next few quarters as well. So I'm actually looking forward to this particular service, buy now, pay later. And their management, if you hear their commentary, they are very bullish on these services as well. They also offer on their app the savings and budgeting tools for the consumer. In addition to that, they recently acquired, when I say recently, I think it's 2018 or 19, they acquired app called Honey at 4 million valuation, which actually allows them to offer basically the optionality in the business by having the e-commerce. This app in particular actually track the prices of the product and give the notification to user. They have recently did some integration in their main PayPal app, and in the future there will be a super app they're planning to launch, which I'll just discuss in a few minutes, which will combine the main PayPal app, Venmo, as well as Honey in one super app. Like I mentioned, the growth since IPO is humongous in terms of the market cap. When they IPO'd in 2015, the market cap was 50 billion. Current market cap is 310 billion, and they're generating 20 billion revenue in 2020, which they are planning to increase it by around 50 billion by 2025. The most of the growth has come, I wouldn't say most of the growth, but a lot of the growth in last 5 years has come through many acquisition and partnership in the international markets. But the most things that I actually want to take, considering the time we have on our hand in like next 2 or 3 minutes, is like the thing that I love about PayPal is that optionality in the business. They already have certain number of users already in the app. By offering more and more services, it's actually much easier for merchants to do the interaction with the 400 million, almost 400 million active accounts. They recently acquired GoPay in China. That's one of the things that the bullish on China is that they are trying to focus on the cross-border transaction in China market. Based on the recent commentary, again, it's China market to be cross-border transaction has to be around 765 billion in 2021. PayPal's penetration in that market is less than 1% right now. I know there's a huge competition in that market from Alibaba's Ant Group, JD, Tencent, but they are not trying to focus on more consumer business. Rather than that, they are trying to focus more on cross-border transaction. Even if they gain that market share by a couple of percent, that will be huge for PayPal in the future opportunities. In the US digital penetration in the US digital penetration in 2019 was 12%, which they are estimating to grow by 24% by 2025. The active account, like I mentioned, by 25 it should be around. They are estimating it to be 750 million. If you compare that to Visa or Mastercard, Visa have around 3.5 billion active users, and Mastercard has around 2.3 billion active users. So if you compare that, they have still a huge runway for growth in future years. So the most thing that I'm again excited about is buy now, pay later. The cross-border transaction in the markets like China, other emerging countries, they already have partnership with Mercado Libre. They have invested, I think, around 750 million in Mercado Libre, which offers the PayPal on Brazil and Mexico integration with Mercado Pago during the checkout, the online transaction. Some of the things, like again, probably it's not valid for us to mention the TAM here because they are looking at the TAM of like more than like $10 trillion or something like that. But yeah, they have a lot of secular tailwind with them in terms of the e-commerce, cross-border payments, cashless society, obviously, like Matt mentioned. So they're planning to grow at least at 20% annual revenue over the next few years. Like I personally use PayPal, if not every day, at least twice or thrice per week. I do trading of crypto through PayPal app. I've done some budgeting tools through PayPal, as well as Venmo is pretty popular, which generates almost like in 2020 $900 million. So, and it became profitable within 3 years after acquisition. So overall, very bullish. I do expect them to continue growing, and like I'm planning to add to my position over the future, and become almost like top 5 position for me. So that's some of the risk, like briefly, Tim already mentioned. The big competition from Square, obviously it's there. Some of the big banks, like Matt mentioned, they are trying to heavily invest in digital payment space as well. But PayPal and Square almost have the first mover advantage. One of the things that PayPal is planning to do, going to launch the Super App, something called Super App, which will have the Venmo, the PayPal, and Honey combined into the one app. So you can do the shopping, the e-commerce, the peer-to-peer transaction, as well as your budgeting, saving tools, and the user loyalty program, everything through the one app. So that's their bullish estimate over the next couple of years, and they're actually betting pretty big on that. So hoping to see this journey very profitable for me in the future, and I hope to hold this stock at least for next 5 to 10 years, if not more. So again, I appreciate the opportunity to talk on this space, and please ping me if you have any question or anything like that. I appreciate it.
Yeah, awesome, Jay. Thank you so much. That was great talk. I love PayPal as much as I love Square. And next week they report earnings. I'm very excited about this. I hope they're gonna give us some information about Super App. That's one thing that's definitely gonna differentiate them from the competition. So that was good, Jay. Thank you so much.
Nice job, man. That was great.
Yeah, awesome job, Jay.
Thank you.
I wanted to give a quick shout out. I see the king of Twitter philanthropy in the house, Mr. Polte himself. So he's done a phenomenal job of making sure that money is getting in the hands of those most in need, and he's doing an incredible job of being able to share his wealth and be able to kind of crowdsource, be able to provide money for those less fortunate. So huge shout out to him. I know he'll be using these various digital wallets to be able to enhance the frequency of gifting. So it's pretty cool to see him on here.
Yeah, sounds good. Thank you for joining, Poto. I really appreciate it.
I think, who do we have next? Is it Kishan? Did I say that correctly? I apologize if I said your name wrong. I think he used to work at Venmo, so he might be able to give some more PayPal insights.
Yeah, thank you guys for having me. Really, really grateful for the opportunity to speak. And yeah, it is Kishan. So just some context, as employee number 20 at Venmo, and as the first hire on the growth team over there, when I joined, it was super small. We had 90,000 users, and it felt like we weren't growing at all in the early days. So as the first member of the growth team, just optimized funnels, revamped the sign-up flow, optimize the invite referrals that everybody probably got invited to Venmo we grew 10x every year after that, and I helped it grow to where it is today. But I just wanted to share a fun, I think, untold story. Is after I joined Venmo, it was acquired, as everybody knows, by PayPal/eBay, and actually Venmo was acquired by a company called Braintree, and Braintree pretty much was an API, very similar to Stripe, helps companies process credit card payments. And PayPal was specifically interested in Braintree, so that's how Venmo became a part of PayPal. And now, of course, the funny thing is, the PayPal CEO calls Venmo the crown jewel of the company. But something nobody really ever talks about is when eBay was trying to buy us, or PayPal was trying to buy us, Square was also very interested in buying us. So they came to our office in New York. I think at that point we were probably like 50-ish or 60-ish employees. And they spoke to every single team member. They spent days, if not a full week or two with us. They looked at our code. They spoke to every single product person, every single engineer. They figured out our roadmap, thought about the business. I think they even spoke to some of our compliance team, and they did not end up buying us. Some of us think that they had no intention of buying us. And funny enough, a couple months later, they launched Square Cash in October 2013. And, you can see that the PayPal acquisition closed, I think it was in June 2013. So it's sort of an untold story about how basically Square came into our office, probed every single engineer on how the company was built, and then went around and built the same exact thing. But overall, as Jay said, PayPal's a great business. I mean, if you're bullish on Square, it's hard to not be bullish on PayPal, and especially with Venmo. Venmo is basically like the younger demographic of Square, and I think most of us, especially myself, have never really used PayPal, but obviously now PayPal plugs into almost every single business. And just for context, I think Jay said this, but I'm not certain. PayPal did close to $1 trillion in total payment volume. That's an astronomical number. And they have almost 400 million accounts versus Square Cash's 30 to 40 million. And now any Venmo user, mostly the young users, and Venmo has more than 30 to 40 million users, they can all transact with PayPal merchants. They can use all the same PayPal accounts. Actually, it's a sort of frustrating project. When Venmo was acquired by PayPal, we were trying to integrate Venmo onto PayPal's rails, and it took way longer than expected, and there was so much bureaucracy, and that's actually when a lot of people left. There was like complete brain drain. I think most of the original Venmo employees left because it just took so long to migrate that. And actually, I think it ended up taking like 3, 4, maybe even 5 years to have PayPal merchants accept Venmo Cash. So it's a real sort of mess there. But obviously Venmo is still innovating. They're doing Venmo credit cards, crypto, basically what the younger demographic wants. Like I said, it's just a great business. Another thing is PayPal is doing $5 billion in free cash flow. I mean, I'm not sure. Obviously, there's more focus on FinTwit, but I'm not sure if the valuation is necessarily justified. It's still a very rich valuation for what it is. And I'm going to make things a little spicy here. I know that everyone in this chat is fairly bullish on fintech. I'm actually fairly bearish, or not bearish. I'm more neutral on a lot of public fintech companies, and I'll kind of explain the rationale. One is there's just so much competition. Everybody likes to talk about how Square can become a bank, will replace banks, and same with Venmo and same with PayPal. There's also a lot of neobanks. There's just like an absurd number of neobanks. You have Chime, N26, Varo. I can't even keep up with them. There's just so many, and all of them are going to try to do the same thing and enter the more lucrative services like mortgages, personal loans, margin loans, whatever you can possibly think of, however to make money. And then also there's so many more fintech infrastructure companies. You have companies like Stripe, which obviously everybody knows about, and Plaid, which I think people are starting to get to know a little bit better. We also have other interesting ones like Synapse Fi, what it's often referred to as. It's basically like banking products as an API, and a lot of fintech businesses are built on top of Synapse. And then you also have a company like Finix, which basically allows any business to become a payment facilitator. And that's exactly what companies like Stripe, PayPal, and Square are. They're just payment facilitators. And what I imagine will happen in the future is, a lot of businesses like, I'll use Airbnb as an example. Airbnb has the potential to monetize payments by becoming a payment facilitator. In other words, that, the 1% fee that they currently, I think, pay Stripe, they can just go ahead and become a payment facilitator and work directly with different gateways, etc. So I think that there's definitely room further up the chain for disruption. I think what is possible, like that's why you can see companies like PayPal and companies like Square focusing a lot more on the consumer side now, because I think that they're realizing that there is a little bit of cause for concern on the merchant side, and I'll get to that in a second as well. But then you also have, it's very easy to see a company like Affirm also become something like a bank, and Affirm also has a great benefit of free advertising everywhere, because now every single site more or less has, it's not necessarily just Affirm, but Affirm, Cabbage, all these different buy now pay later services, they have free advertising everywhere and free user acquisition. In fact, they get paid for these users. So I think I wouldn't be surprised if Affirm tries to shift into the Square Cash, Venmo territory. Not necessarily more like Square Cash or Venmo, probably more like a PayPal-esque thing where it can be like some sort of a bank or balance, not necessarily the peer-to-peer payments. And I guess the main reason why I'm bearish too is just I was in these companies early. I guess perhaps it's the problem of knowing a little too much about the industry and just being a little jaded by it. But I bought in at PayPal at 37, sold that after like a 3 to 4x gain. Bought in Square at 20. I was super bullish at 20, not as bullish at 250, and sold out of that as well. But I think the future, in my opinion, is more vertical solutions. I actually really like Shift4. I think it's a much smaller company that's more focused on hospitality, and is a little bit more focused on monetizing payments as well. But that being said, if you like Square, there's absolutely no reason to not like PayPal. I mean, I think you should like PayPal a lot more, because I think the one reason why people are bullish on Square is because of Square Cash. And Venmo, I mean, Venmo's a predecessor to Square Cash, has almost every single feature minus the brokerage features. And Square just actually has pretty anemic growth. I think they've juiced a lot of their growth through this nonsense of booking Bitcoin sales as revenue. It actually, I think, is going to hurt them in the long run. I think everybody expected them to have slow growth because of COVID. But now, once those numbers are already baked in, they're going to, I think, potentially see anemic revenue growth. But yeah, I don't know what else I could share beyond that on Venmo specifically. But Venmo is still growing super rapidly. I mean, the payment volume is just astronomical too.
Yeah, man, thank you so much. That was a very great insight. I really appreciate to hear from someone who actually worked in the place. I totally agree with you that the amount of competition in this industry is unbelievable. But I think that Square and PayPal definitely showed that they are capable of executing, and I think that execution is gonna keep going the same direction. And I think that they're gonna definitely be one of the winners, long term at least. Not sure about the short term, but long term definitely winners. So I really appreciate you sharing all of your knowledge. Thank you.
I'm curious, Kishan, really quick. Are you long for, and what other fintech companies or traditional banking companies are you long, if any?
I am long for. I honestly even forget what I'm long sometimes. 4 is probably my biggest fintech holding. But honestly, beyond that, I mean, like Amazon obviously has Amazon Payments. I'm long Amazon. But that's about it. I mean, obviously one company that I'm long is Shopify. I don't know why that's necessarily obvious, but I'm long Shopify. And I think that Shopify is a good example of a company that's slowly trying to monetize payments through uh, through these infrastructure plays like Stripe. I mean, they they they've built all of these different sort of Shopify products. I mean, Shopify Pay, Shopify Balance, Shopify Card, whatever you want to, like, all these different things on top of Stripe. And now when you use Shopify Pay, they get a non-trivial fee on top of that. And I think that's what's going to happen is you're just going to see more and more of these companies take a little, but they're going to monetize payments. I mean, that to me, like, there's a possibility that every company will become a fintech company eventually, where everybody just competes on monetizing payments, and that's like in the limit. It's not necessarily in the short run. But yeah, I mean, I'm not long anything. And unfortunately, a lot of the good fintech companies are private companies. Obviously, Stripe being first and foremost. But I'm only long for, and I guess some of these other plays that I think can monetize payments.
Thank you. I appreciate it. That was a really good job. Thanks so much. Moving on, we have Alex next. Shockingly enough, this wasn't planned. He's going to be talking about Four, so this is kind of a perfect segue. So, Alex, go ahead.
Hey, thanks for having me here, Kishan. I think you made a perfect segue for me, and that I really believe as well that the industry is getting really overcrowded, and that the value is in people who can build on top of that payment gateway. And so that's kind of really why I like Shift4 so much. So just a little bit here, they IPO'd last year. They're a leading provider of integrated payment processing and technology solutions processing, and they process actually more than 200 billion in payment volume a year. Not only for me is this a reopening play, but my view is that they continue to take market share in this highly fragmented point of sale industry and drive more revenue with its current customer base. So just a little bit of background about the company. They've actually been around for quite a while. Shift4 was founded in 1999 by Jared Isaacman in his parents' basement when he was 16, after he saw inefficiencies in the payment industry. Since the beginning, the goal has always been about simplifying complex problems for merchants and capturing payment volume. One of the things that I know a lot of people look out for here is founder-led companies. This is exactly one of them. He's still the CEO and chairman and has become one of my favorite founders. A little bit of background about him. He co-founded a company that trains pilots for the Air Force and operates one of the largest fleets of privately owned fighter jets in the US or in the world. He also set a world record for circumnavigating the globe, and earlier this year announced he would serve as commander for Inspiration 4, the first private human spaceflight operated by SpaceX. So I think that's pretty cool there. So again, the company has a software solution that helps merchants accept digital payments, which has been a long-term bullish trend that has not only accelerated due to the pandemic. Their main focus and roughly 75% of their total payments processed come from the hotel and restaurant verticals. Well, this has definitely been a challenge during the pandemic, where these businesses have taken a huge hit. Shift4 has still managed to grow payment volume, which is a testament to their product. A little bit of a quote from their CEO on their first earnings call last year. He said, "We have anticipated on several occasions where the puck is going to go, and that has been a great benefit, especially of late when it comes to things like contactless forms of payment, like our SkyTab and our QR code-based payment products. Both of these are offered at no additional charge to their customers, which is a really compelling value proposition." So to me, why I like Shift4 is that their business goes just beyond simple payments, and they have a clear strategy to get its customers to spend more and bring in new customers. They offer a gateway-only channel, which connects merchants, payment processors, and merchant account providers. And a little bit what Kishan said is just that, that space is getting really crowded. They're just offering that payment gateway, and they aren't offering a lot of services on top of that. But the difference for Shift4 and what their growth opportunity is that they offer a payment solution. So think about this. Most merchants have to manage a confusing set of vendors, acquiring, and many more. many more things. You add in loyalty cards, online ordering, contactless, multiple locations, and things start to get really complicated. So to me, that brings us why people move to Shift4, and that's because of their end-to-end solution and cost reduction and complexity. So as I mentioned earlier, merchants can subscribe to Shift4 via their gateway channel and rely on other software integrations. But if you go to their end-to-end solution, it puts all those functions to a single vendor, and they can really scale up using that. And what's great, Shift4 can actually convert your whole system within 24 hours. So it's just a very impressive product. As well, the company can generate 4x or more gross profit from an individual customer who winds up paying the other individual vendors. And as well, they get features on top of that for free, such as I mentioned, the QR code payments. So they really create this opportunity by offering all these value-added services because their main driver here is transaction volume. So in Q2 20, roughly 11% of overall volume was driven through end-to-end solutions, but that volume represented 80% of total volume. So this means there's a unique opportunity to convert those customers that are on the gateway and drive revenue. And we've seen that in the last couple quarters. In Q3 2020, end-to-end payment volume grew just over 20%. And in Q4 2020, that end-to-end payment volume grew 12% year over year. So this is a testament to a growing business, especially as restaurant and hotel businesses are depressed right now. So it's really important to see. They have a ton of customers. Through roughly 200,000 businesses in North America that rely on Shift4 payment technology. And in 2019, that represented roughly 200 billion in payment volume. So this right there is where their huge opportunity lies, is converting these customers to their end-to-end product. Customers are using their gateway, they see the value in this end-to-end product and move over. So this is what they view as their main market that they're going after right now. But it's important to see there's just a ginormous TAM. It's almost too big of a number to look at because they list their TAM as US payment volume, which is trillions. But either way, they have this access to this 200 billion in payment volume that they're slowly moving over to their platform, which they can make that 4x gross profit on. So how I see this is that there's really this coiled spring within this business as the economy fully opens back up and bringing on customers to that end-to-end product. To me, I look at two really interesting free sources, which everybody can look at here to look at how this business is progressing. Open table data, which is publicly available and shows restaurant bookings every single day and how they compare to last year. So that's important to see how the economy is opening back up. And then Shift4 actually has an amazing data set on their own website. It's at shift4.com/shift4care. And this is really great. They share weekly and daily transaction trends for restaurants, hotels, and other businesses. And while the data starts back in April 2020, transactions are up 2-3x from that time. So just as I said, Shift4 has considerable market expertise. They work with 20,000 hotels, 125,000 restaurants as clients, brands like Four Seasons, Hilton, Hyatt, our customers, fast food companies, Arby's, Denny's, Wendy's, KFC, and even casinos like Caesars Entertainment are on board. Shift4 thrives on these complex systems. You look at Caesars as a great example. They have 30 different software applications powering hotels, golf courses, salon, and spa. They need all that network together, and that's a big reason why they go with Shift4 and why a lot of their other customers go with them as well. Just shifting outside of their core business, and another reason why I'm bullish on them is some of the recent acquisitions they've made. They recently acquired a company called VenueNext, which is a leader in point of sale and mobile commerce and loyalty solutions for venues. They work with every major professional sports league and dozens of universities and Six Flags. They recently announced they're the official payments partner of the Las Vegas Raiders. So they're really trying to expand their business here, which is great to see out of restaurants and hospitality. Another business they're shifting into, they recently expanded into the e-commerce vertical with Shift4 Shop, which again is going to be a new layer of growth. This is to me, a perfect example of integrating features for their customers. this rebranded acquisition was doing billions in payment volume and sending volume to third parties, which merchants were paying other vendors for. So what happens here is they can use this payment volume to bring into their end-to-end solution and grow their platform. And obviously, they're going to compete with big companies. They're going to compete with Shopify. They're going to compete with a ton of other e-commerce giants. But this is a way that they're seeing this payment volume and talking to these customers now that they've acquired to bring into their ecosystem. So I think I've covered the story hopefully pretty well, and I just want to touch on the financials real quickly here for anybody looking at the company. At IPO, they did pay off a big chunk of debt, but that has recently gone back up. They're sitting right around $1 billion in long-term debt. Much of this has to do with the acquisitive nature of their business and buying some of that payment volume so they can use that to convert to their end-to-end product. At the same time, though, cash has also gone up. They're sitting right around $1 billion in cash, so I'm not so concerned about this debt and these acquisitions, given we've seen them convert their customers the last couple of quarters being public. So that also goes in with the acquisitive nature. CapEx has also gone up, but they do see the significant opportunity to onboard new merchants and shorten that payback period. So I think I've said enough here, but I believe there's still a significant amount of room for growth ahead for Shift4 as the economy opens back up. You know, people travel, stay at hotels, eat at restaurants across the U.S. There's still a huge runway here. And I think, again, as Kishan mentioned, it's a hugely crowded market, but I think that Shift4 is doing an amazing job with integrating their end-to-end product into complex systems that I think is going to have a lot of value moving forward.
Yeah, absolutely. Thank you so much, Alex. That was good. I don't have a position in Shift4 Payments, but the company definitely looks interested, especially after listening you talk about this. I really appreciate you, John, and thank you so much for sharing all the information. That was great.
Yeah, thanks, Alex. I don't think many on Twitter do have a position in 4, but it's definitely been a good IPO. I think it's actually been one of the best IPOs of last year. I think it's at all-time high still.
Yeah, it's up 200% since its IPO, and I love this company. It's been so kind of like under talked about online, and because they went public where all the businesses they work with were depressed, were closed, and so I don't think people were as focused on it. But I think there's a huge runway for growth, even though the stock is up quite a bit. And again, there's free resources to look. I'll post them online as well. But it's a really great fintech company to follow.
Sounds good.
Again. All right. I think we're moving on to, I think it's Max, right? I think Max is going to cover fintech in Russia, if I'm not mistaken.
That is correct. Thank you so much, Mark. Really excited to talk about this. Even I saw a post that Wolf just made maybe a couple hours ago before we started about all the people being excited about stocks, but he didn't mention fintech in Russia, so I was kind of offended about this. But it's all good. So yeah, I'm gonna go ahead and talk about the industry overall really quick. I know I have about 10 minutes. I'll try to not to take more than 10 minutes, but I'm going to start with covering the industry, and then I'm going to talk really briefly on a few players in this industry. So let's go ahead and dive in. So when it comes to penetration of fintech services in Russia, it's among the world's highest, actually. About 80% of the population use such services, with money transfers, payments being the most popular of them. But Russians actually do not trust independent service providers, and they're not willing to share their bank information. Shocker. According to the study that I came across, only about 18% of Russian users of fintech services are willing to do so, compared to the average global figure of 46%. So I definitely see some room for growth in this industry. About 80% of Russians use some sort of fintech service, making the country the third most developed market in the world after China and India, based on one of the studies from Ernst & Young. According to the study, money transfers and payments are the most popular financial services among Russians, as 90% of the country's residents have used the service at least once. And the awareness of other fintech services is also pretty high, between 85%. There are services that Russians hardly use at all, such as investments and securities. So savings, investments, budgeting, financial planning are the areas that have the highest development potential. Overall, Russia's financial system is relatively young, so it's actually easier for consumers to embrace innovation. The Russian financial system is not as conservative as it is in Europe. So basically, they switched from Soviet era style savings books to payments over mobile phone almost overnight. So Russian consumers are more receptive to fintech innovations, which explains the popularity of this service. Russia's financial system is concentrated around banks, and banking institutions are key investors in fintech projects. So customers prefer traditional banks or insurance companies' offerings to services offered by companies outside of the finance sector. Pretty interesting fact that I came across while I was preparing for this talk is almost half of Russians are ready to trust companies from outside of sector that have a partnership with a traditional financial institution. But in case when there was no partnership, this figure dropped to 13%. That's a pretty significant drop if you ask me. So that was my basic overview of what's going on in Russia in fintech industry right now. I would like to dive into the three companies that I personally think are well positioned to grow in this particular sector, such as fintech. So the first company is Yandex. I'm sure some of you guys heard about Yandex. It's one of the competitors to Ozon. So what is Yandex? Yandex is a technology company that builds intelligent products and services powered by machine learning. The company's goal is to help consumers and businesses better navigate the online and offline world. So Yandex is essentially the Google of Russia. So you guys will be able to understand exactly what this company does, and it has a lot of different revenue streams, not just web searches or advertisement. I will touch on this a little bit later. Yandex is best known as the Russia-based search engine. The company has since expanded and launched taxi and e-commerce subsidiaries, which is Yandex Taxi and Yandex Market. So now let's touch on the company's financials really quick. I think last week, actually, Yandex released its earnings report, which touched Q1 in 2021. Let's go over their balance sheet really quick. So when it comes to cash, they have about $3 billion on their balance sheet, which is pretty impressive if you ask me. When it comes to P&L, the company has three main sources of revenue. It's online advertising, taxi segment, and sales of goods. So let's touch on all of these revenue streams really quick. Online advertising revenues grew about 20% in Q1 compared to Q1 in 2020 and generated 49% of total revenues. So pretty much half of their income comes from online ads. Revenues related to the taxi segment grew about 57% in Q1 and accounted for 28% of total revenues. Revenues related to this segment include revenues from ride-hailing, logistics, Yandex Eats, and Yandex Drive businesses. They do have a lot of different businesses, which I think they are pretty well diversified. Revenues related to sales of goods grew about 814% in Q1 compared to Q1 in 2020 and accounted for 15% of total revenue. So there's just mind-boggling growth in this sector. Income in this segment is derived from Yandex Market, first-party sales, Yandex Lavka, where they use first-party business model and act as a direct retailer. Other revenues grew about 125% in Q1 and accounted for about 8% of total revenues. Some of the other revenues include revenues from media service subscriptions, marketplace, third-party fees and commissions, and Yandex Cloud. Yeah, they actually do offer cloud solutions as well. So there's a lot to be excited about when it comes to this company. Net losses actually were reported at $56 million in Q1 compared to about 73 million of net income in Q1. And those losses were mainly driven by consolidation of Yandex Market and increases in share-based compensation. just from what I've been doing some research on this market, what I saw is Yandex is trying to compete so hard with Ozon, and that's why they have been reinvesting a lot of their proceeds from a lot of different revenue streams back into the business. So they think that they should be able to compete pretty well in the next 5 to 7 years with Ozon. And the most recent update I found on their website a couple of days ago, Yandex announced that it has entered into an agreement to purchase 100% of a local bank. The purpose behind this transaction is to obtain a banking license required to develop Yandex Fintech vertical and launch comprehensive digital finance products and services for their users and partners. So that's pretty much it for Yandex. Now let's jump into the second company that I actually found pretty interesting. I received a bunch of DMs and I see a lot of posts about this company on FinTwit. The name of the company is Tinkoff. Tinkoff was founded by Oleg Tinkov in 2006, so it's been around for about 15 years. Oleg Tinkov is a Russian entrepreneur and businessman. In 2014, he was ranked the 15th richest person in Russia with a net worth of $8 billion. The company's CEO is Oliver Hughes, who was appointed in 2007. So they have the same CEO for the past, 14 years. That's pretty impressive. So what is Tinkoff? Tinkoff is a cloud-based bank that offers a range of financial and lifestyle services, including credit products, various accounts, business services, investments and insurance products, travel tools, loyalty programs. The bank is Russia's second largest credit card issuer with about 13% market share. But unfortunately, Tinkoff is not listed on New York Stock Exchange, but it is listed on the London Stock Exchange. And has a market cap of about $5.5 billion. Should be pretty good fit for Jonah's portfolio. It's below $10 billion. So Tinkoff Bank is the world's largest digital bank in terms of customers and includes more than 10 million clients. It has no branches, and the company serves all of its customers remotely via online channels and a cloud-based call center, which includes about 10,000 employees. It's pretty much like a neobank, has no locations, and it's been growing very fast. On March 11th, they released their earnings. Let's go over their earnings report really quick. Total number of customers reached 13 million, which was up from 10 million. This makes Tinkoff's Russia's third largest bank by the number of active customers and its largest digital-only player in the financial sector. The company is on track to expand their customer base to more than 20 million over the next 3 years. Their investments in brokerage platform reached over 1.25 million total customers by the end of 2020 and generated revenues of about $100 million. It's an over 8-fold increase. The company is growing exceptionally fast. So this is one of the areas that I really enjoy about this company. In December, Tinkoff Investments' active customer base represented more than 60% of all active customers on the Moscow exchange. 60%, that's a lot if you ask me. Their credit business increased the total number of customers to about 7 million, with net loans rising 14%. The company's share of retail credit in Russia increased to 8.6% as of January 2021, which made them the second largest player in this segment. When it comes to the number of monthly active users across the main interface, it increased from 6 million to over 9 million. The company's users count keep growing at a pretty rapid pace. So to summarize, I haven't done too much research on this company, but based on what I saw so far, it definitely makes me want to dig deeper. Who knows, maybe in the next couple of weeks, I will post a thread or something. So I know I'm over 10 minutes, but I've been covering multiple companies. So just third company really quick that I would like to touch, and it's probably going to be a surprise for you guys, but I would like to touch Ozon. And I did a... So Ozon started developing its fintech products in 2018. Today, the fintech business includes B2C and B2B services that are complementary to Ozon's core e-commerce operations. One of the services the company provides is Ozon Invest, which is a financing platform that enables marketplace sellers to get loans from a number of financial institutions in Russia. During 2020, Ozon expanded its fintech initiatives for both buyers and sellers. Ozon fintech services aimed at providing access to lending and payment assistance solutions to both its B2C and B2B segments. In Q4 of 2020, Ozon launched a virtual Ozon card. Ozon card holders showed greater customer loyalty and demonstrated higher order frequency, and they grew at a pretty exponential rate. It's to about 450 clients as of today use Ozon card. And I think last month Ozon entered into an agreement to acquire 100% of one bank. This acquisition will help Ozon to expand the number of financial services products offered to the customers and the merchants on Ozon platform. The company's expectations are to increase engagement and retention of its buyers and attract more sellers to Ozon marketplace. So to summarize it all, I definitely see the potential when it comes to fintech in Russia. I do have a pretty good understanding of Ozon, but I haven't done too much research on Yandex and Tinkoff, and that's probably what I'm going to do next. I'm sorry, guys, if I went over 10 minutes. I think it was about 12 minutes. So I'm done with my presentation.
Good job,
Thanks for listening.
Thanks, Max. I think you did a pretty good job there. It's funny how, Ozon wasn't a very well-known name either on the Twitter, the FinTwit space, and it ended up being a pretty good IPO last year. I think it's up like 50% plus last year. I mean, just going back to 4, another name nobody knew, also had a great year. It's just funny to see the most overhyped and most known names actually haven't performed well at all from 2020. So great job. Thanks.
Yeah, I appreciate it, man. Thank you.
Speaker?
Yeah, the next speaker is Wolf. He should be covering.
Right?
Yes, we can.
Perfect. Awesome. Let's get right into it. Thank you to everyone who's here listening. Again, I know that we're over an hour into this. I really appreciate everyone that's being around. I'm hoping associate Josh is recording. I am scared that his phone might have died or something because I'm not getting a response. Josh, if you're out there, reach out to me. I'll try to record the second half if not. Also, I just Pulte, who was on here, someone who I've been following for a while. So Tim, great point out there. But let's dive right into you because a lot of people have a ton of interest in this company. So just on the background, Futu was founded in 2011, and they provide online brokerage services in Hong Kong and mainland China. Are expanding, and they do have other subsidiary holdings underneath the Futu that are coming out to other areas, such as Mumu, which is used in these areas. What Futu is essentially banking on is that this middle class in China, household wealth in China, is booming as the regulatory environment opens up, and they think that a brokerage with fantastic UI as well as social services, which I'll get into in just a second, go ahead and capture this market. So just from the Boston Consulting Group right now, the is set to increase by 14 trillion by 2023 and reach 35 trillion. Credit Suisse places that even higher at 39 trillion. So there's a ton of, a lot more of the middle class is getting into investing. They're investing a higher amount of their savings. So like I said before, the Futu plan to win is betting that the new generation of investors with a well-crafted user experience, user interface, and various social features. So just to kind of pull a quote from their S1, and as everyone knows, a great place to go is looking for information on different companies. This is what Futu's S1 said. They said, "We have embedded social media to create a network centered around our users and provide connectivity to users, investors, companies, analysts, and key opinion leaders. This fosters the free flow thought of information, reduces information asymmetry, and supports the investing decision-making process." And then this is, I think, the really important, is they say, for instance, users can exchange market views, watch live broadcast events, and participate in educational courses offered. Importantly, serves as a powerful engagement tool. So my page and what this is one of the biggest reasons I love what Futu's doing. I think that there's a combination in social media and investing. We kind of do it here on FinTwit where we talk all the time, but if you've been on the Wolf team's building, you've seen the real social and research and data, and that's what Futu is doing. So a lot of people are calling them, the Robinhood of China, but I think that they're much more like if you took Robinhood and Reddit and then cross those over in China. And the biggest thing to that is having a social community on your platform will extend the amount of time that people spend on your platform, and then that can extend the amount of time that they're going to be placing these trades. So their user base is insanely growing. So I'll just throw some numbers at everyone. So total, let's go. This was reported at their last earnings in March. The brokerage added, this is paying clients, 100,000 paying clients, 98,632 in Q4 alone, getting 161% growth rate for a year-end total of over 500,000. 121 clients, which are the one that I'm focusing on because obviously you're making a lot from those paying clients. The total client assets surged as well, 227% in the fourth quarter. And then obviously something that draws a ton of people to Futu is the financials. They are just insane. They're eye-popping. I spoke with Jonah on our call that we did on Thursday. We did a Twitter space and we chatted a little bit about Futu, but they are just growing at crazy numbers. So just go back to their last earnings. Their earnings exploded 800% to 49 cents a share, beating expectations by 8 cents. Revenue 283% to $153 million, also beat. So they're really coming in with some hot numbers here. That revenue for 2020 ballooned year over year to 427 million. And you can go into Yahoo Finance and just take a look at how fast they are growing. Back in 2017, they were only at 202,000 for total revenue on the top line. And now, that number, well, that's 202 million. My bad, because all numbers are in thousands. Top line revenue, 2,614 for trailing 12 months. So it's insanely rapidly. And just what attracts me to it is, as I've already stated, this environment of social and finance, I think just comes together to create something absolutely beautiful. People can spend a lot of time with, and I'm glad that they're doing it in China and not here, so that Wolf can take more of those people and get more of that business. One thing which I'll point out, which I thought, I did a lot of reading through what other people had written about this, and obviously, if you haven't signed Jonah's newsletter, you should go ahead and sign up for that. It's a fantastic newsletter. He breaks stuff down really well on his Substack. And one of the things that Jonah mentioned is Substack right off the bat. Many people are worried coming out of China that their financials are going to be credible. In many ways, they smudge financials. However, is Price as their auditing firm, and Skadden, Arps, Slate, Meagher, and Flom as their legal counsel, reputable firms. And honestly, even if Futu's smudging these numbers a little bit, they're still flowing to see what's coming out of there. So just a ton of different questions. Just going to a little step further, they underneath the Futu kind of headquarters is Futu Inc., Futu Bull, and Moo. So they're not just one company that you're buying into. You're buying into really multiple companies covering a large part of the globe in many different areas, and continue to expand. For anybody that saw recently, they did a stock offering actually to beef up the balance sheet, to offer people more margin. And not a lot of people loved it because of the price that they put it at. However, they're making so much money, and their net income margins are around 50%. They're growing at 120 to 130% this year. So just really, can't say enough about these financials and where the stock's going. So I personally took a position in Futu at $45 a share. That was, I believe, last year, maybe earlier. Been kind of flying. I saw it in a benchmark article. So if you haven't checked out that, checking them out. And if you look at the stock, they've really done a lot at looking nice from both a technical as well as a fundamental standpoint. And not a technical analyst. However, I do have some friends that do technical analysis. Starting right about January 1st, made a run from around $40, all peaking mid-February at $191. I think that, that's what they're showing me on the chart. I remember 200 one of those days, just watching closely. And then it dropped back, immediately rebounded 50% back up to near 160. And now it's been sitting around 150. So I believe if you look at the 50-day moving average, you're going to be it's holding it really, it's sitting above it. So for me, I'm not going to run too long on this. I look at fundamentals. I look at the technicals. I love the business model. I think that they have a massive audience in China with, like we just stated, a growing middle class that's going to possibly have 39 trillion in assets that they're looking to invest. Just like here, China are also trying to take a hold of their own funds, communities like we are, FinTwit community itself, and a ton of potential in the area. So I'm certain that Jonah is hearing everything I'm saying and probably has plenty to ask you Upstart. So that's all that I'm going to cover for Futu today. I just model of the financials. So thank you to everyone for listening. I really appreciate y'all being a part of Financial Fitness, and thank you, Max, for hosting.
Yeah, absolutely, man. Thank you. That was great talk. It was kind of funny. Then last year, I was super close to establishing position. It was around $60, $65, and I mistakenly thought that it was overvalued, and then I missed all the run up, and now it's trading in the middle of 100s or something like this. So I definitely missed on this opportunity.
Yeah, you got to start.
Yeah.
You got to start
Thanks
following.
a lot, man. I thought you did a pretty good job.
Oh, sorry. I was going to say you got to start following more newsletters.
Go ahead.
That's all I was going to say. Follow Benchmark and follow.
Yeah, good job, man. I remember watching Futu last year. I couldn't do it, dude. That stock's gapping up 20% a day, and then it's fading to plus 2% like every day. And it's just like that stock. Just watching that stock wore me out, but it's been a great stock. Yeah, appreciate it. Thanks.
So I think the next speaker is Jonah. I'm really excited to hear him talk about Upstart. Me working in the financial industry when it comes to banking. I do a lot of commercial underwriting for the credit unions around the United States. So Jonah, floor is yours.
Yep. Okay, cool. Yeah, before I talk about Upstart, I just want to add a couple more things to Futu. So I actually had a call with the marketing team from Futu on Friday, the U.S. team, and they're definitely trying to grow more in the U.S. to take on Robinhood and Webull. They look at Robinhood and Webull as their two biggest competitors in the U.S. If anyone noticed, they actually so Futu Bull is the Asian app, and then Moomoo is the US app. And Moomoo was actually one of the sponsors for the Berkshire Hathaway annual conference yesterday. So if you saw any of the flyers that went out on social media, you'll see the Moomoo logo was right there in the bottom left-hand corner. The other thing I'll note before I jump into Upstart is Tencent, which I think everyone probably knows Tencent as the this giant technology / internet conglomerate from Asia. Tencent was a very, very early investor in Futu, and they are currently the second largest shareholder after the founder of Futu. So, back to the credibility of the numbers, I think when you have Tencent as the largest outside shareholder, as well as some of the VC firms that are still in there, like Matrix and General Atlantic and Sequoia, I think you can be pretty comfortable that the numbers are legit and credible. So Futu remains one of my biggest positions. I think this could be a $250 stock by the end of this year. So we'll see. One last thing. I mean, when you
really quick, sorry. Oh,
yeah.
Sorry. I'm curious. So when did they come to the U.S. and do you know anything about their U.S. business? I'm just curious since you had the conversation.
Yeah, I don't know exactly when they came to the U.S. I mean, I tried to probe her for some details on what percentage of their users are U.S. and she wouldn't give me a hard number, but it sounds like it's probably less than 5% overall. That's where the bigger money is, because that's where there's actually less competition. But now how much money they're willing to spend to grow in the U.S., I have no idea.
Thank you.
Okay, so I'll talk about Upstart now. So Upstart is still one of my biggest positions. I think it is number one right now. I'm not going to give the exact percentage, but it's a pretty meaningful position. It's been in my top three basically all year. So I've been bullish on Upstart since December when I did my Substack write-up on the company right after their IPO. I'm mad at myself for not knowing more about this company when they did the IPO. I believe they came public around the same time as DoorDash and Airbnb. So they kind of got lost in the shuffle there. So, it was a decent IPO, but it wasn't one of these like really hot, retail, foaming at the mouth IPOs like Airbnb and DoorDash obviously were. So, I think the company came public around 20 or low 20s, and then it popped up into the mid to high 20s within a couple days. I jumped into Upstart probably around 35 or 36. Did my write up around 40, and as we know now, I think the stock's about 109 as of Friday's close. So they've had a pretty wild year. Coming into this year, the expectations on revenues were for around $360 million, but when they reported their Q4 numbers, they raised that guidance for 2021 to $500 million, which is obviously a monster raise. Now, I don't think they had given the 360 million unless that was maybe in the S1. I'd have to go back and check, but either way, going from 360 to 500 changes the story. Obviously, the stock got re-rated, and we saw the stock jump from 56 up all the way to 165 within a few days, and then it pulled all the way back down to like 92 or 93, and then now it started to move back higher, like I said, about 109. So I call Upstart they're not really a lender. They are enabling other lenders to use a digital first AI approach to underwriting. So Upstart was started about 9 years ago by Anna and Dave Gerard, both from Google. And then Paul, the third founder, was a Thiel Fellowship member. If anyone knows, Peter Thiel put this program together where he would, I think, essentially pay people to drop out of high school or not go to college and join his Thiel Fellowship and try to start a company. Thankfully, Paul got partnered up with or found Dave and Anna because they've been working on this AI model for 8 or 9 years, which is part of their moat or competitive advantage. So they have a massive head start on any other company that wanted to try to build an AI powered platform like this, because that 8 years of head start means that they have billions and billions of data points to use that have enabled this AI model to become smarter and smarter over time, which is exactly what AI and machine learning are all about. So the traditional underwriting model platforms use FICO scores, which are extremely archaic. They were created 30 years ago. They really haven't changed at all. And what Upstart created was this AI model that uses 1,600 data points or variables on an individual to determine their credit worthiness, whether or not they should get the loan. And over the last 8 years, they've powered over 700,000 loans with, millions and millions of repayments or missed payments. And those all become data points and variables that help the AI get smarter and smarter. So you add it all up, and Upstart says there's now over 15 billion cells of data that have enabled this AI model to become better and better over time. So there's different ways so about 98% of the money that Upstart makes is through fees by enabling these bank partners to use their model. And these customers or the borrowers either come into Upstart I guess they get their loans either by coming to upstart.com and applying, and then Upstart will provide offers from their bank partners, and then obviously the potential borrower can pick which offer or which rate they want, or a potential borrower would go to one of their bank partners' websites and apply for a loan, and they're essentially, that loan or that underwriting process is essentially getting powered by Upstart, but the borrower has no idea because Upstart's obviously created a, digital first interface so that the borrower just assumes that everything is running through the underwriting platform of the bank, not knowing that platform is being powered by Upstart. So, the borrower doesn't care because, by using this AI model, I believe it's the average borrower gets about a 16% cheaper interest rate. And they get more offers because of all these bank partners if they're coming to upstart.com. But the more powerful number is banks are able to issue 175% more loans by using Upstart without increasing their default rate, which is obviously where the risk lies in doing lending to begin with. Banks right now in the U.S. are they have the strongest balance sheets in history. I don't know if people realize that. I mean, the amount of cash that's sitting on these bank balance sheets is just astronomical. A lot of this was obviously money that came in from the Fed and the Treasury that people didn't get to spend last year because they weren't leaving their homes. And there's just trillions of dollars sitting on bank balance sheets right now. And the only way banks really make money off of that money, off of those deposits, is by doing lending. So, over the next few years, we could see just a wild amount of lending and credit going out to consumers, in personal loans and auto loans and mortgages and everything else, just because of the strength of the personal balance sheets as well as the bank's balance sheets. So I think this is a really ideal time for Upstart to be, not just coming public, but expanding the number of bank partners they work with, and now they're expanding the types of credit they can work with their bank partners. So, they first started working on personal loans, so loans between, I think it was 1,000 and 50,000, and that's what they've been doing for the last 6 or 7 years. And as of last year, they're now getting into auto lending, which is a $650 billion market by itself. And then on the last earnings call, Dave announced that they acquired a company called Prodigy, which is a digital first auto software platform. So Dave kind of explains it as the Tesla version, I suppose. So when you go into a Tesla store, not really a dealership, more of a store, and they give you an iPad and you can, play around with it and customize your car and, apply for loans and everything else. That's essentially what Prodigy wants to do for everybody else, for the rest of the car industry, all of these dealers. And I assume it's going to be online dealers as well. And then that's how Upstart can kind of plug in the lending portion and have kind of first crack at these people buying cars. So I think it was a really smart acquisition. It's going to help them kind of catapult into the auto lending faster now by not just selling software to these auto dealers, but also kind of, like I said, having first crack on the lending side of it. And I think they'll be able to accelerate their growth in bank partners by having this AI software that is available for both personal lending as well as auto lending. Because a lot of people, when they go get a car loan, they still walk into their local bank or call their local bank or go to their local bank's website or, Bank America, TD, whoever it is, and that's where they apply for an auto loan. Now, I mean, a lot of the banks that they're working with right now are kind of, I don't want to say no-name banks, but they're certainly not like your big national banks that we all know, Bank America, Citigroup, et cetera. I don't know if or when Upstart works with those companies, because I don't know if those companies are trying to develop their own AI in-house or if they're willing to outsource it to a company like Upstart. So most of Upstart's current bank partners are, I call them like mid-size regional banks that typically have anywhere from 10 to $50 billion in assets and loans, which are great. They're obviously doing a lot of lending, so those are great partners for Upstart. But it'll be interesting to see if Upstart can get into those bigger national banks or the digital first banks, the Squares, the Sofis, et cetera. If Upstart can help power their lending, I mean, it just I mean, the upside is almost limitless for a company like Upstart just because of the size of the credit markets. I mean, just in the U.S., I mean, you're talking when you add up personal and auto, and if they get into mortgages and student loans and credit cards and small business loans, I mean, you're talking trillions of dollars a year in total addressable market. Now, obviously, their fees would only be a portion of that, but still, I mean, this is a company that I've been bullish on for the last 4 months. Like I said, I continue to be very, very bullish on what they're doing. If I could only own 3 or 4 stocks for the next 2 years, Upstart and Futu would absolutely be 2 of them, just because the fundamentals are so strong. Both companies are already profitable. I know that they both pulled back in that whole growth, the growth pullback in early March, where we saw the 10-year going up. So companies that weren't profitable were getting pounded. And that's why I doubled down on these 2, because they're both profitable. I mean, they're both generating net income and free cash flow. And they both did recent secondary offerings to, fortify their balance sheet. I was a little shocked by both. I was a little more shocked by the Futu one, I suppose, but I guess if they're going to spend that money to increase margin for their customers, which will create more trading and options, then that's how they justify it. The Upstart one is a little more surprising, unless they're planning another acquisition, I suppose, because it's such an asset-light business model with really, really high gross margins. I'm not really sure why they would need a whole bunch of more cash in the balance sheet. But, when your stock goes up 3x in a couple months, I guess it's not a bad idea to take advantage of that and, build up the cash reserves.
Thanks, John. Great job, man.
Thanks.
I do have a question for you real quick.
Yep.
You said obviously those two are your favorites. If you had to pick between the two, which one do you think long-term would you rather own?
I'd probably pick Upstart if I had to, just because it's not, non-Chinese, and that Chinese thing is always a risk and will probably always impact valuation at some point or create bigger sell-offs in the future, based on regulations or trade wars or, God knows what else. So I think from like a risk standpoint, Upstart is probably a little bit more favorable.
Yeah, I agree with you. Really quick, do you think that those huge players with deep pockets will be interested in acquiring this company at some point?
Oh man, I mean, it's hard for me to guess. To be honest, I don't know. I'm not so sure it would even make sense, right? Because the benefit of Upstart, the value of Upstart is being sort of a neutral party and being able to sell their AI software or platform to all of the banks. So if one of the banks bought them, what sort of conflict does that create if they're then trying to sell that software to the other banks that they compete with? So I'm not sure. Unless it was like a Visa or a MasterCard that is, more agnostic when it comes to, the big banks. I could see something like that would make all the sense in the world. I'm just not sure if a payment processor would want to get into the, the AI lending space.
Yeah, that's what I meant. Of course, like when we talk about like Bank of America or Wells Fargo or Chase, there definitely would be conflict of interest. But when it comes to like Visa, MasterCard, maybe even Square or PayPal at some point.
Or like a Google.
Google.
Someone like a Google. That would be, or PayPal. But like even PayPal sort of competes with the big banks in some ways. PayPal. Yeah, I would say Visa and MasterCard are probably like the most agnostic to the banks. PayPal and Square are definitely starting to, creep into the bank's margin or, how they make money with lending and deposits and everything else. So, yeah, I could see someone like a Google, Visa, MasterCard. Upstart's only an $8 billion company right now. As much upside as I think this company has, it's still under $10 billion. It's still considered a, even a small mid-cap stock. So, without and I really don't even want them to get acquired. There's certain companies in your portfolio that you don't mind them getting acquired because you feel like you can put that cash into other ideas. Like I really would not want Upstart to get acquired because I fully expect this to be one of my best positions for the next 3, 4, 5 years.
Along with Ozon, I assume.
I do want to get. I forget if did I get back in Ozone? Yeah, I did get back in Ozone last week.
At least that's what you tweeted me about that you did. I think it was on Friday.
Yep, I did. Yeah, I sold it a couple weeks ago. I think in the mid 60s. I forget the number. Hoping for a pullback, and it pulled back a little bit. I think it pulled back to the 20 or 50 day. I think it pulled back to the 20 day, and that's when I jumped in.
Thank you.
Yeah, thanks, John. I really appreciate it.
Yep.
I think we're moving on now. We have Tinkoff SPACs. I don't have a name for him, but he covers all things SPACs, so we're going to take it a little bit differently. I think he's going to be talking about Sofi, one of Chamath's best, I would say, SPAC that he joined up with. So go ahead, King Tut.
Thanks, Mark. So the stock we'll be speaking about today is Social Finance, also known as Sofi. Sofi is an online personal finance company that's currently going through a SPAC merger with the social capital Sofi the fifth, ticker IPOE, which is run by FinTwit's favorite, Mr. Shamat Palihapitiya. In full disclosure, I have a position in the stock. I'll try to keep it short, but no promises. Before we dive deep into the company, let's speak about the opportunity for digital banking and fintech as a whole. The global digital banking market, also known as neobanks, is set to rise by 15% a year over the next 5 years, reaching 16.2 billion by 2025, up from 5.2 billion in 2019. This increase will be driven by the growing smartphone penetration, customer appetite for digital solutions, and the need to rationalize costs within the banking industry. Last April, Jamie Dimon, chairman and CEO of JP Morgan Chase, listed fintech as one of the enormous competitive threats in his annual shareholder letter. Dimon said that banks are making great strides in building both digital and physical banking products and services, from loans to payment systems to investing. They have done a great job in developing easy-to-use, intuitive, fast, and smart products. Dimon added that fintech's ability to merge social media, using data smartly and integrating it with other platforms, will rapidly help these companies win significant market share. This is a perfect segue into Sofi. Sofi reminds me a lot of Amazon's beginnings. When Amazon started in 1994, it was basically just an online bookstore. Almost 25 years later, Amazon now does everything you can imagine, from e-commerce, cloud computing, digital streaming, artificial intelligence, groceries, logistics, you name it. I even read the other week that they just launched their first hair salon in London. Sofi was founded in 2011 by 4 students who met at Stanford. Their goal was to help solve the student debt crisis by giving students access to lower loan rates than the federal standards. Sofi's mission statement is to help members get their money right through achieving financial independence to realize their ambitions. Sofi wants to help customers with every financial step of the journey. 10 years later, Sofi has expanded from just an online student loan lender to positioning itself at the center of the fintech revolution. They've now established itself across 3 different business segments: lending, technology, and financial services. I'll speak about the technology part later. For lending, Sofi does student loans, personal loans, home loans, in-school loans, and recently announced auto loans. For financial services, Sofi has a suite of products. First, Sofi Invest, which is basically the brokerage aspect to buy, sell stocks, crypto, ETFs, robo-advisors, all which is zero commission. Sofi was also one of the first to introduce fractional shares, which allows the everyday investor to buy fractions of shares that are quite expensive, like Google or Amazon. They've also recently introduced IPO investing, which will enable their members to purchase shares of companies before they're publicly traded in the stock market, something that was only allowed for institutional and wealthy investors. Take into account that their invest feature is very new, just launched 3 years ago, so they have a lot of room to grow. They plan on introducing new features such as stop loss, pre-market and after-hours trading, options, warrants, level 2 data, and margin quite soon in 2021. Second, Sofi Money, which is the banking aspect of opening a checking or savings account. Third, Sofi Credit Card, self-explanatory. But one cool thing they announced last week is the 2% cashback rewards that can be redeemed towards crypto such as Bitcoin and Ethereum, which is even better than the 1.5% that the BlockFi credit card offers. Also, quick fun fact, Sofi is an investor in BlockFi since their Series A. Fourth, Sofi Relay, which allows users to track their money in the bank, credit card, investment, and loan balances through a single user interface, as well as set individual financial goals. Fifth, Sofi at Work, which is an employee benefit program for companies to reduce student debt and build financial wellness of their employees. This program currently has over 600 participating companies across the US. Lastly, there are other services such as renter's insurance in partnership with Lemonade and auto insurance in partnership with Root. From all those different services, Sofi's aim is to be a one-stop shop for its users, enables them to cross-sell its different products in the process. From their investor presentation, they use the acronym FSPL, which stands for Financial Services Productivity Loop, which means that you build trust and relationship in the first product that then drives success into the next one. By doing so, Sofi is increasing its customer lifetime value and reducing its customer acquisition costs. Currently, the company says that around 40% of Americans use more than one bank account as their primary bank doesn't offer fully integrated services. Sofi bets that it can attract those customers and convert them to its modern and fully integrated digital banking products. Sofi currently has 1.8 million unique members and is predicting to have 3 million members by the end of 2021. To put that into context, SoFi had just 700,000 members in 2019. Next, which is something I really like, is SoFi's marketing efforts. SoFi relies heavily on the power of community and touching on the social aspect. First, SoFi experiences. Pre-pandemic, SoFi regularly hosted group dinners, professional workshops, happy hours, volunteer opportunities to build connections across all 50 states. Over the past year, they've also hosted over 100 virtual events for their members as a replacement to the in-person due to the pandemic. Second, SoFi's Inner Circle, which is their brand ambassador program where members can earn special access to events, swag, and other perks in exchange for representing the SoFi brand. Third, SoFi's social investing aspect. On SoFi Invest, members have the ability to discover or follow other members' investment holdings, watch list, and activity. They created leaderboards to see where members are standing amongst one another, which really puts a social aspect into investing. Fourth, which I made a thread about 2 weeks ago, is SoFi's digital communities. With over 55,000 members, SoFi has a closed Facebook group where members can communicate and interact on a daily basis, not just on financial matters, but anything really from everyday life. Apart from SoFi, the only other US-based neobank that has a Facebook group is Chime, with half the number of members, around 20,000. To my knowledge, none of the traditional banks such as JP Morgan, Chase, Citi have such an extensive community where members can interact with one another. Fifth, customer service of SoFi is great. From the in-app chat to phone numbers to Facebook groups, Twitter support to even Reddit support, members can really get in touch quickly and promptly with customer service across all those platforms. Lastly, SoFi has also invested heavily in sports sponsorships to attract and reach the Gen Z and millennial audience. SoFi has a 20-year naming rights deal for SoFi Stadium in LA. SoFi Stadium is the home stadium for NFL teams, LA Rams, and the Chargers. In the next 10 years, SoFi Stadium will host the Super Bowl in 2022, college football playoffs in 2023, WrestleMania in 2023, FIFA World Cup in 2026, and will be the home of the opening and closing ceremony for LA 2028 Olympics. This will generate crazy visibility for the brand of SoFi, not just in California, but nationwide. They've also done multiple esports-focused sponsorship deals, such as the one with the Misfits Gaming Group, again, to go after that Gen Z gamer-savvy audience. Going into their management. In my opinion, SoFi's management is as good as it gets. SoFi is led by Anthony Noto since February 2018. Before joining SoFi, Noto served as the CFO and COO of Twitter. He was involved in the process of getting Twitter public and was considered Jack Dorsey's second. Prior to Twitter, he served almost 4 years as co-head of global tech investments at Goldman Sachs and was also the CFO of the NFL. So he knows banking and Wall Street quite well. Taking a quick look on LinkedIn, their employees from executives all the way down to coordinators are coming from Silicon Valley and blue chip companies like Google, Apple, Uber, Facebook, Amazon, Microsoft, and more. Now I'll do a quick dive on Galileo, SoFi's technology platform. In April 2020, SoFi acquired Galileo Financial Technology for $1.2 billion. Galileo is the engine behind neobanks and fintech, not just in the US, but globally. The number one fintech out of the UK, Canada, and the US all use Galileo. According to the CEO, Galileo has a 95% market share of digital banks in the US. In the US, Galileo powers the likes of Robinhood, Chime, MoneyLion, Dave, Albert, Curbank, and Varo. In the UK, Galileo powers the likes of Revolut, TransferWise, Monzo, PaySafe. In Germany, Galileo powers the neobank powerhouse N26, and in South America, Galileo powers the likes of Voala and Futu. Galileo initially started in prepaid cards and now has a platform with a range of financial services in the banking as a service industry. They provide companies with an easy-to-use, easy way to create customers and B2B financial services through its open API. Through their API, their clients can create and manage their accounts, authorize payments, manage card balances, and get fraud protection. By 2020, Galileo was already powering over 50 million accounts, up from 20 million accounts in the third quarter of 2019. Galileo has also established presence in the Latin American region through launching an office in Mexico last month, and they're also going after the Brazilian, Colombian, and Argentinian market. South American market as a whole for fintech is untapped and a huge opportunity. Galileo also plans to expand even further in Southeast Asia and Europe. To put it simple, as fintech and neobanks grow over the next 5 years, so will Galileo. Galileo will also enable SoFi to vertically integrate their financial services. SoFi will enjoy a cost advantage compared to tier 2 banks, but it will also supply the infrastructure that tier 2 banks need. In this case, SoFi's unit economics will be hard to beat by these banks. Over the next couple of years, I believe that Galileo will expand their API services to offer more services such as buy now, pay later, payment systems, and more. Going back to the beginning of my Amazon analogy, Galileo to SoFi is the same as Amazon Web Services is to Amazon. A couple of things to add about SoFi. SoFi has received conditional approval for US bank charter in 2020, and last month acquired Golden Pacific, a small community bank, to accelerate that process. A bank charter will benefit SoFi in durability, lower cost of capital, increased net interest margin from holding loans longer, and will enable growth in lending. Upon merger completion, SoFi will have about $2.4 billion in cash to fuel further growth, expansion, and potential acquisition. It's worth noting that SoFi expanded to Hong Kong in 2022 on acquisition, and I personally believe their next move will be in South America, Europe, and Canada. SoFi generated $620 million in revenue for 2020 and expects to reach $1 billion in 2021, which will also be the first year where they end up EBITDA positive. SoFi is currently trading at around $13 billion valuation, and the merger is expected to close by end of May, early June. To wrap it up, SoFi is not for everyone. It's not built for the financial or trading savvy who has a high net worth bank account with Chase and a 7-figure trading account with Fidelity. It's built for the next generation, the millennials, Gen Z, and Gen Alpha, who are born connected around digital communities. With SoFi, you're getting a wide array of offerings that other competitors offer. Traditional legacy banks such as Chase, Citibank, Bank of America, lending platforms such as Upstart and Lending Club, brokerages such as Fidelity, Schwab, Robinhood, Webull, crypto exchanges such as Coinbase, BlockFi, eToro, robo-advisors such as Betterment, Wealthfront, M1 Finance, fintech infrastructure such as Stripe, Plaid, Marqeta, and Synapse, and potentially later on, buy now, pay later, like Affirm, Klarna, and Afterpay. Under 11 minutes, so thanks for listening and hope you enjoyed.
Yeah, that was great, man. Thank you so much for joining. SoFi is a really interesting company that I probably need to do more research on, but interested to watch their international expansion as well. Thank you.
Yeah, I think you did a great job. Thanks so much for coming. So a few years ago, I used SoFi to refinance my student loans, and they definitely offered me the best rate. I mean, I shopped around for quite a while, and SoFi did give me the best rate, and they've been pretty good as far as customer service, and I've enjoyed the experience. So no negatives on their platform and the rates they provide. They did a pretty good job for me. Yeah, thanks again. I think moving forward, we have Chris, who runs Potential Multi-Baggers. He spoke also for Deval, I think it was last month or maybe the month previous, for the FinTwit Summit. I know a lot of people raved about his pitch and presentation, and I even think he went over by 30 minutes and people were still loving it. So without further ado, sadly he only has 10 minutes, but we got Chris. Go ahead.
Hey, I actually allow him to use 15 minutes since he's going to be covering 2 companies, if it's okay with you.
Yes. Hi, how are you?
Good, how are you?
I'm great. I'm enjoying this, so I will start immediately to use my 15 minutes. but first, I actually wanted to talk about something general. I mean, about the space. What you see is that banks, and then I mean traditional banks, are like the infrastructure for fintech, and they have built the networks. And this reminds me of the internet and how it was built. The infrastructure was built by companies like Verizon, AT&T, etc. But they haven't, caught the biggest gains because that was companies like Google, Facebook, Amazon, them. So the companies that were built on top of the infrastructure, and I think the same will happen for companies built on top of banking infrastructure now. So with fintech, so big banks will be okay, but nothing exciting. They're heavily regulated, as we have already heard a few times, just like the telecommunication players. And I think fintech is at the same place where the internet took off, or really took off. And that means a ton of competition, and at the same time, a lot of winners as well. So that was something that popped in my head. So, and I thought, well, let's share that. I'll start with Mercado Pago. Mercado Libre was founded in 1999, and 4 years later, then Mercado Pago was founded. And I looked it up, and in the S1 in 2007, when Mercado Libre had its IPO, the total payment volume of Mercado Pago was 26.6 million for the whole year of 2007. Now in 2020, that was 49.7 billion. And that means a compound annual growth rate of almost 80% on average over 13 years, which is incredible. So, you know, in the fourth quarter of 2020, the total payment volume was 15.9 billion. That was up 84% year over year. But, you know, there's a high inflation in certain parts of Latin America, and more specifically, you know, the home turf of Mercado Libre, Argentina, which had 42% of inflation over the last 12 months. So that means that the actual growth in local currencies was actually, you know, 135%. And the interesting thing about Mercado Pago is that the off-site payments are now bigger than the on-site payments. So that means that in Latin America, a lot of offline stores accept Mercado Pago. And if you look at the numbers of Q4 2020, you see that 6.8 billion of total payment volume was on the site, so on Mercado Libre, and 9.2 billion was off the site. And I think that is really interesting to see. 75% of the numbers, or of all transactions also, were offline, which means that Mercado Pago is used a lot for smaller purchases offline as well. So I think that that's really interesting to see that 3/4 of the things paid with Mercado Pago were actually, you know, made offline. And, you know, that's during the pandemic. That's also important. You know, offline, but, you know, it grew. The offline payments grew 150% offline during the pandemic, which is crazy, I think. So if you look at the numbers of the online total payment volume, you see that, you know, there was a big boost of the coronavirus. Before the pandemic, in Q4 2019, total payment volume grew, online grew 46% and 36% in Q1 of 2020, and then 111% in Q2. So you see a huge jump there. But if you look at the offline, you know, it was 176% in Q4 2019. It was 139% in Q1. It was 175% in Q2. It was 197% in Q3 and 150% in Q4. So, you know, despite the fact that it's already bigger than online payments, it's still growing faster as well. And I think that is very interesting. And it's also interesting because you'll see that C Money or Shopee Pay actually uses the same strategy. So maybe just a quick overview of the business of Mercado Pago. So what do they have as solutions? So they have a mobile point of sale solution, comparable to Square's original business, you know, the card reader for credit cards and debit cards. Mercado Pago actually has two, one, you know, exactly the same as, or more or less the same as Square, and the other one is more, you know, swiping. Then the core product is the digital wallet. So, you know, I think a lot of people will know the utilities there, what you can use it for. So you can use it to pay your utility bill. You can use it for QR payments, which are actually quite popular in Latin America. Of course, P2P transactions, cell phone top-ups, transportation tickets, etc. So you can pay that from your balance on Mercado Pago, or you can pay that with the traditional bank account that is linked. And then also very interesting, I think, is Mercado Fondo. And Mercado Fondo, which means market fund, is actually a fund. So it gives users the opportunity to invest in low-risk assets. You can place money in an open-ended fund and take it out again. And I've looked it up, and low risk really means low risk. In Argentina, the stock market dropped by more than 10%, and over the same period, the Mercado Fondo fund only dropped 0.9%. So it's really low risk, and it's very interesting because people are encouraged to leave more money on Mercado Pago. Maybe Mercado Pago could add stock trading as well, but I don't think they will do that immediately. They will first focus on other possibilities, I think. So then you have the merchant solutions. Checkout for payments online, etc. Credit cards. All those things. Then the prepaid card, which may sound a bit old-fashioned, but they are quite popular in Latin America, and they make sense. And they often provide, good margins for Mercado Pago as well. And the card can be used anywhere, and you can also withdraw money at an ATM. So that's also interesting. And then Mercado Credito, so that is a credit solution. And that is loans for both merchants and consumers. We have already heard that others do it as well. So Upstart, for example, but also Shopify and Mercado Pago use AI and use the purchase history and combine that with algorithms. So they see, or they can determine who they give credit to and who not. So it can be used by merchants, and it can be used by consumers, and they can even apply offline via the point of sale system. They also have insurance, although that is a smaller part. It's just damage and theft insurance. Again, they have the possibility there to to expand, but I don't think that they will do that soon. But it's it's one of their opportunities, definitely. And then for the Bitcoin bulls, also a bit of candy. Mercado Libre has just launched a test case on their real estate division, where it will start with Bitcoin. Mercado Libre is just the connector, and the transaction is done offsite between potential buyer and a real estate agent. But I think it could be very interesting because in Argentina, I already said an inflation of 42%, and people are only allowed or restricted to buy $200 of foreign currencies per month. So Bitcoin and other cryptocurrencies are seen as a safe haven a bit, actually, which might sound strange to Western ears, but if you have 42% of inflation, I think it makes more sense. So Mercado Pago is trying that out to see if there's enough interest. And then about a month ago, I think, it also launched a credit card together with Visa, first for its own customers, but then for the whole public. It's without an annual fee if you use it for at least $10 a month. And it also has some sort of buy now, pay later system in that way that you can buy up in up to 18 installments without any extra interest. So I think that's very interesting as well, and can definitely boost the buying power of certain customers, and it will be a boost for Mercado Libre's e-commerce platform. And then the second one, C Money. Everybody knows that I'm a huge C bull, and I think C Money is still underrated. It was launched in 2014 under the name AirPay. You still sometimes hear it, and I think they still use it in 1 or 2 countries. I'm not sure which one. It was actually meant for unbanked and underbanked customers who wanted to pay online in Garena Plus games. So Shopee wasn't launched yet in 2014. That was only in 2015. And then it saved the company a lot of money because he didn't have to pay commissions on its transactions. And now it offers e-wallets, payment processing solutions, micro-lending, other digital financial services, which we all know. And I saw a quote of Forrest Lee, and I will read it. And he wrote that on the first quarter of 2020 conference call. And he said that based on a recent Google, Temasek and Bain report, Bain, of course, the digital financial services industry in the 6 largest economies of Southeast Asia is expected to grow at 22% compound annual growth rate between 2019 and 2025 to reach 38 billion in revenue in Southeast Asia alone. So based on the report, 3 out of every 4 adults in Southeast Asia had insufficient access to financial services, and 49% are underbanked. So this is really similar actually to Mercado Pago, and I think it's sometimes underappreciated by Western investors that the situation is completely different there. And for a lot of people, those digital wallets are their first, banking account. So it's not, it's better than in Latin America. It's a bit better, but because there are more people in Southeast Asia, the total number is higher. So on a percentage base, it's lower. On the number is higher. So there's a massive untapped opportunity still there, and I think C is perfectly positioned to capture that. If you compare Shopee Pay with Mercado Pago, it's already much further in its trajectory than Mercado Pago was at the same age, to call it 7 years old. Also very important is that C Money has been able to get a full bank license, digital full bank license in Singapore, and it did that independently, so not in combination with the traditional bank. And in Indonesia, it has bought 2 smaller banks, which also sets it up to get a banking license there. The biggest market, Indonesia, is the biggest market in Southeast Asia, 270 million people. And there are projections that show that Indonesia could be the 4th biggest economy in the world by 2050. So very important and very early. So what I also see is that my subscribers, they send me pictures of cashback discounts at the counter in Singapore, in a local shop or a bakery or whatever. So you get 2% back if you pay with Shopee Pay. And that also means that C pushes Shopee Pay offline as well, just like Mercado Pago has done. And another initiative that it has taken recently is Deals Near Me. A few weeks ago only, it's an O2O feature, so online to offline. It shows you deals online, temporary promotions, vouchers, and those kind of things to go buy something in your local store. It was also launched as a means of recovery for merchants after the pandemic, of course. And it was started with 130 shops, and in the first 2 weeks of them, those 130 shops saw 100,000 visitors because of the Deals Near Me feature in just 2 weeks, which is incredible, I think. It really shows that C is great at making people adopt something extremely fast. Of course, they only get the benefits when they, or the customers only get the benefits, the deals, when they pay with Shopee Pay. So that again will be a boost for the revenue of C Money. As with Square, as with Mercado Libre, you see the combination of the two ecosystems, so merchants and customers that are brought together, which gives the opportunity to cut out the middleman. And of course, there's a lot of insights that banks don't have. For example, when you put something expensive into your basket and you don't pay for it, maybe you don't have the money or you think it's too much, and Shopee Pay can offer you a buy now, a pay later solution, for example, or consumer credit or something like that. So, and as you may know, Shopee was launched in Brazil as well. So maybe, probably in Mexico soon. So over the longer term, Shopee Pay and Mercado Pago could actually become competitors. So I went a little bit over time, but I did my utmost best. I think my subscribers to Financial Multi-Baggers, Multis, they know that I could go on for a very long time if it's about C. So I really did my best.
Yeah, you did great. I think we can just host spaces particularly for these two companies, and you probably can talk for like an hour. So that was
yeah, I could.
That was great presentation. Thank you so much.
Thank you very much. It was my pleasure.
Thanks, Chris. I don't know if it was today or last week, somebody posted it that C Money is now hiring for general insurance and life and health insurance. So I'm not sure if you saw that, but it should be interesting.
Yes. Well, there are a lot of things in the pipeline, I think. They also have their AI arm right now. So now I'm thinking, will they combine the two, the AI and the FinTech? Probably in some way. So a lot of opportunities left there.
Awesome. Thank you so much. Max, or what do you want?
Yeah, I think we have our final speaker, Andreas. He will be talking about AGC, one of the specs as well, potentially merging with Grab. Andreas, are you ready?
Yeah, I'm ready.
Thanks, Andreas.
So I'll be talking about a SPAC, which is called Altimeter Growth Capital, or AGC. It's a bit funny that this company that they're taking to a SPAC went with the SPAC route, because it's actually a huge company. It's called Grab. It's out of Southeast Asia. It's based in Singapore, and it was actually, believe it or not, Southeast Asia's first decacorn. It barely beat C Limited to the punch when it crossed that valuation in the private markets in 2018. But as we know, C Limited has been an absolute growth monster, in large part fueled by their massive smash hit with Free Fire. So it has actually surpassed Grab quite a bit. So something about Grab. Grab was founded in 2012, and they claim to be Southeast Asia's leading super app. It was founded by Anthony Tan, who's from Singapore, and Tan Hoi Ling, who's from Malaysia. They met in Harvard Business School in the United States, and they decided to found Grab. Grab started out very similar to Uber, named Grab Taxi. So they started out as a ride-hailing service in Singapore. So and since then they've built into becoming sort of an everyday super app. They do ride-hailing. They've gone into food delivery. They've gone into to fintech. And they've gone into wealth management, insurance, and lending. So, and as well as grocery delivery, and all kinds of stuff. And something that's pretty interesting about Grab is that they're really going with the super app strategy. Their mission statement, which I really like, is to drive Southeast Asia forward by creating economic empowerment for everyone. So that's really the key idea behind them. So the idea is that it's built up about with three apps. So there's the consumer app where consumers can verb in Southeast Asia where they operate. You can just grab a Grab, and they'll take you everywhere. So and it's not just cars. You can be picked up by a tuk-tuk. You can be picked up by a bike. You can be picked up by all kinds of different vehicles, and most people don't actually own a car in Southeast Asia. So the margins, as you can expect, are generally a lot higher than for Uber. So Grab is actually profitable in many of their key cities that they operate in. So that's the consumer platform, and where consumers can order a taxi in the morning, perhaps, then they can order food later in the day, then they can maybe also order some groceries. So you can really see, and maybe even invest or shop online and get some service through Grab's Buy Now Pay Later service. So you can really see how this can be an app that you can open many times, and Grab is trying to drive as much value out of each single user and just get them to use the app for everything. So their model is they're trying to be the WeChat of Southeast Asia, where users just use this single app for everything, and it just grows massive in scale. And it has worked very well for Tencent. So surely it just might work in Southeast Asia as well. So there's this the other app is of course the driver app, where drivers can, between what they find most what they want to work with at the time, depending on where the demand is, whether the demand is for ride hailing, for food delivery, for grocery delivery. You can simply just choose whatever thing you want to work with at the time. So that's a really good way to utilize your workforce if you're Grab, and it's sort of the similar thing that I think Uber is doing. So you can really it really becomes a pretty good job for people, especially also because generally I think the pay is it's seen as it's not seen as a terrible job in Southeast Asia. Like it's definitely not high status, but it's not seen in the same way. So sort of like as an Uber driver, where you can't really where some people might not be able to earn a living wage out of it. So So Grab has recently been going into and building out their fintech platform, and it's actually also center point in the consumer app. Like the payments is front and center if you download the app. So they're really trying to present Grab as not just a ride-hailing app or a grocery delivery app or a food delivery app, but also as a fintech platform. So I think we should talk a little bit about the numbers. So Grab did 12.5 billion of gross merchandise value in 2020 company-wide. Of that, 5.5 billion was in deliveries. So food delivery and taking up the majority part of it, and that's because it's grown with a 203% CAGR between 2018 and 2020. So mobility is actually not Grab's largest segment any longer, in large part because the segment was severely hurt by the global pandemic in 2020. So they did 3.2 billion GMV in mobility and 8.9 billion of total payment value in their financial services arm. But bear in mind that a lot of this revenue was intercompany revenue, so people that use GrabPay to pay for other Grab services. So this is not, say, as impressive as if people were using GrabPay to pay for in their local 7-Eleven, or when they are buying things on other e-commerce sites. So, but still, Grab is expected to grow very rapidly. By the company presentations, they should be growing at a 42% CAGR from 2020 to 2023. And I think these numbers should be achievable because, and this is like where you have to put some trust into the management and the people behind it. I think that Brad Gershner of Altimeter Capital is not trying to pull a fast one on investors. Also because Altimeter committed 0.75 billion of their own money towards the SPAC when it went public. So they have a big economic incentive for this IPO to go well. Something about the valuation here. Grab went public. Grab is going public at a valuation of $39.5 billion in market cap, and that's at the $10 SPAC IPO range. So that's quite steep. Bear in mind that after this SPAC, they will have a total of 9 billion in cash. So by my calculations, that amounts to around a 28 times trailing months EV to sales ratio and a 16.31 forward EV to sales ratio. So this is a really expensive growth stock. It's actually even more expensive than C Limited. So there's definitely something there about the valuation that I'm not going out and filling my portfolio up with Grab shares at this valuation. I think that it's a long-term buy because, as Chris said brilliantly before, the growth drivers of Southeast Asia are just so incredibly. It's just such a giant tailwind when you have a really young demographic, a really fast growing population. They're mostly unbanked. They're they're just now getting into the app economy. So there's really a really long runway for growth there. And since Grab is such a leading brand and they have a leading position in all of the key markets, in ride hailing and in food delivery, it's a bit more competitive with one of the largest competitors being Delivery Hero, which owns Foodpanda. But they're a solid second in most of their markets. Indonesia is the most competitive, which is a bit of a shame for Grab because there's a very large company called Gojek, which is backed by Google and numerous other very strong backers that has a very strong position in Indonesia, but Grab is still a very solid second, and they're neck and neck with App Store downloads. So I think Grab is obviously has more App Store downloads than Gojek. Because they're operating so many more markets. So they have, I think, 4 million in total, while Gojek has 3 million. And the biggest, you could say that, like, it's not a super direct competitor. It's C Limited. Like, that's just the biggest tech company they're competing with, and they will be competing against them sort of in fintech. But I mean, we all know how Fintech is such a giant market. Like, there will be so many players in Southeast Asia as well, just as there are a lot of players in the US. But so C Limited has 13 million downloads, so you can kind of see that in total on the App Store. So you can kind of see the scale of Grab and their competitive position here. So yeah, I think. Okay, yeah, and the last thing I want to say before I give it back to Mark is that there's a massive beast of a pipe here. Apart from the 0.75 billion from Altimeter, there's also $4 billion from very renowned investors such as T. Rowe Price, Mubadala, BlackRock, Fidelity, and Temasek. So I think that gives a lot of credibility to the IPO, and I think that will help keep it from falling below the $10 mark. But of course, there are no guarantees, and this is really a story where execution makes or breaks it, because it's always like that when you have almost an infinite TAM. Like, it's great to have a big TAM, but you also gotta execute in order to grab it. No pun intended. So that was all for me, and I'll give it back to Mark.
Yeah,
Yeah.
absolutely. Go ahead, man.
Max. Sorry. Nope, you.
I just wanted to ask really quick if you have any updates on the merger between Tokopedia and Gojek. Do you have any information on this one?
No, I think there hasn't really been released anything yet, as of yet. So there was a rumor that Tokopedia might have to sell their fintech arm, Ovo, to Grab in order for the merger to be able to pass. So this would obviously be a massive boon for Grab, as Ovo is, I think I haven't really looked that much into it, but I think they're very big in Indonesia, where that's Tokopedia's main market. So, but yeah, no, I think the BTWN that most of the rumors were involving, that they're going to merge with Traveloka, which it's not really a company that I think is very impressive. The SPAC has really also been sold down. I think it's around $10, because I think investors are kind of seeing that Booking.com, they have bought out Agoda, which is a very big player in Southeast Asia in the travel category, and they're definitely the leader. So if you're buying into Traveloka, you're buying into a pretty distant second there.
Perfect. That's good. Thank you.
Yeah. So thanks, Andreas. I appreciate it. I haven't really studied Grab, but I did read into Altimeter Capital, and I've read that they're a very good fund, and I've seen the VC space and other people on Twitter really complimenting them on the deal and saying it's a very fair deal and a good company. So, like you said, myself, I'm a little surprised that they went the SPAC route as well. Grab, that is. Yeah, and then in closing, really briefly, I'll pass it to Max in a sec, but thanks so much, everybody, for showing up. Really appreciate all the speakers and providing all the knowledge that you guys provided over the 2.5 hours that we spent here. Other than that, I think Max might have an announcement on another one coming up in a few weeks, or if he wants to close it out, feel free. But again, thank you so much, everybody that showed up. If you have any questions, feel free to DM me or Max. Happy to get back to you. Thank you.
Yeah, absolutely. Thank you so much, Mark. And we do have an announcement that on May 16th, which is 2 weeks from today, we're going to hold our next chapter 3, which will be dedicated to the gaming industry. We're going to have 10 speakers, and we're going to cover companies like Unity, like Skills, like C Limited, Garena, Gravity, a lot of other interesting companies. So I'm really excited about this. And tune in on May 16th at 2 p.m. Eastern Time. That's going to be super awesome. Just like Mark said, thank you for all the speakers today. I think we had an amazing event. I think at some point we had about 400 plus listeners, which is amazing. I really love that a lot of people tuning in and trying to learn as much as they can on their weekend. That's great. So hopefully they'll be able to apply some of this knowledge when the market opens next week. So thank you for all of my speakers. Please follow all of them. I always appreciate them participating, sharing their experience. I learn a lot from all of them. So thank you, guys. If any one of my speakers have anything to add, feel free.
Oh, just thank you, everybody, and Max and Mark for including me. That was a fantastic event. Thank you.
Mm-hmm.
Absolutely, Tim. Thank you, bro.
Max, mind if I say something real quick? I want to give.
Go ahead, man.
Of course, he just gave a shout out to all of us to go follow us, but Max is the one who's putting in the work behind the scenes. It really takes a ton of effort to put together these spaces, to coordinate with so many different people all around the world with different schedules. Is just a huge thing. So really, the appreciation goes out to Max. Make sure that you're following him because there's more of these spaces coming up and he's putting in a lot of effort, and it's not even his job, right? Like this is, my job is creating spaces. Max works full time and then comes home and like has a kid to take care of and still goes out and makes all these spaces happen.
Yeah, I think Max is definitely the true hero out of everything. I mean, out of everybody here, Max is, he's courting all the people to speak. He's going above and beyond. He's trying to put these things on like literally almost daily. It's getting almost crazy to me. I'm like, whoa, man, you're on fire here. So yeah, good point, Wolf. Really appreciate Max, everything you do here.
Yeah, thank you, guys. All these events would not be possible without all of my speakers and without all of the listeners. So I think it's a team effort. So, we learn from all our previous experiences, previous events, and the next chapter is better than the previous one. And it's amazing. I really enjoyed it. Thank you for all my speakers. That's been great. So if you guys have anything to add, and I was actually super pumped that we went about 2.5 hours and spaces did not crush me a single time. My mic has been working for the entire event. So that's definitely an achievement.
I'm sorry. I know we're going to go here in a second, but I'm curious if you guys can message Max or myself. How do you guys feel about 2.5 hours? Is it too long? Is it too short? Is it perfect? Like any suggestions that you can throw in that can make this better in the future, just so it's more, simple, quick, and not necessarily quick, but it flows well and you enjoy being here and, on your Sunday. So thanks.
Yeah, absolutely. We're always open for any suggestions or criticism, so this is exactly how we'll learn and try to make it better for all of our listeners. So I guess if you guys have nothing to add, then I'm going to go ahead and end the spaces. Enjoy the rest of your Sunday. Thank you, guys. And
have a big earnings season week next week, guys. It's a huge week for FinTwit. FinTwit favorites, I would say. I know my portfolio. So good luck to everybody.
Yeah, and hold on. One more thing that I wanted to add really quick. That tomorrow we're going to be hosting another spaces event. Brian Farod and Chris Peruna will be joining for like an hour quick Q&A session. So if you guys have any questions, please shoot me or Wolf a DM, or just comment under the post that I made last week, and we'll go from there. Thank you guys. Take care.